The resilience, I think, has taken a lot of us by surprise.
We are seeing the drag from higher prices weighing on consumers' ability to spend as we move forward.
We've read far too much into recent Fed speak that implied that these higher rates might have actually done some of the heavy lifting.
Is the long end doing some of the Fed's work for them? Absolutely, but that's proving not to be enough.
It kind of feels like we're in a sort of everything everywhere all at once market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Our top story this morning, President Biden touching down in Israel. His trip unraveling before it even started. A single blast at a hospital in Gaza killing hundreds. Israel is blaming Hamas. Hamas is blaming Israel. Tensions already at boiling point across the region. The explosion threatening to tip things further over the edge. The president says he's outraged.
I was deeply saddened and outraged by the explosion at the hospital in Gaza yesterday. And based on what I've seen, it appears as though it was done by the other team, not you. But there's a lot of people out there not sure. So we've got to overcome a lot of things.
The stakes for this trip could not be higher. How do you prevent the conflict from spreading? How do you ensure aid gets into Gaza and civilians are kept out of harm's way? Our team coverage begins right now with Bloomberg's Ollie Crook in Tel Aviv. Good morning, Ollie.
Hey, John. Yes, President Biden has arrived here in Tel Aviv. He was greeted on the tarmac by Benjamin Netanyahu, who said the only thing better than having a friend like you is having a friend like you here right now. And again, this is a very different trip than Biden had planned to do 24 hours ago. This was a two-legged trip originally, first stop in Tel Aviv, second stop in Jordan to deal with the sort of diplomatic side of it. And really the question is, what can Biden achieve here? Yes, he can show support for the Israelis, as every other official has done from the United States that has been here, as Chuck Schumer was in this very building a few days ago. Yes, there is the deterrence factor with the aircraft fleets and 2,000 soldiers, we understand, on high alert. But the third bit, and probably the most crucial part of this trip, the diplomatic side, has been completely scuppered by the explosion in this hospital in northern Gaza, in Gaza City. And there was supposed to be that meeting with El-Sisi, the Egyptian president, the king of Jordan, and as well Mahmoud Abbas, and that has been completely torn to pieces.
What are the ramifications, Oliver, for the president and for the American contingent that the Arab part of the trip is canceled?
I think it's huge, Tom. I mean, you saw the protest pictures across the world hours after this happened in Gaza. Protests in Lebanon, in Jordan, in the West Bank. The fact that the rest of the Arab world is incensed about this. And even though President Biden, as we heard in the introduction, considers from what he has seen that this was not an Israeli operation or a fact that has not yet been totally clarified, this is another 500 people dead in a hospital that has been overburdened. And for many people in the region, that is not really going to be the sticking point. That is a bit of nuance that is perhaps not really in the front of their minds.
Oliver, we're hearing that Iran is calling for an oil embargo against Israel based on what we saw, the explosion at the hospital. I am curious how much this is percolating out, how big the risk is based on the people you speak to, and more of a risk is there of some sort of escalation in the region?
I think it's only gotten greater since what happened last night. Again, it's the shutting down of that diplomatic channel and those conversations that would have been absolutely key. And again, what can Biden achieve here? Potentially, again, this is a bit of speculation, but maybe getting some of that aid moving from the southern border of Gaza with Egypt at Rafah, getting that into Gaza to pull some of the relief a little bit would be a sort of diplomatic step forward. But apart from that, it's very hard to see. And we're going to be watching for the president's press conference in just a little bit of time after he's met with the Israeli leadership. But we understand also some of the victims that encountered the attacks in southern Israel. And so we'll be watching for that press conference in about, we don't know exactly what time. And it's a very fluid schedule. But we're going to have to see what line Biden walks.
Ollie, I want to pick up on something that you suggested in the last minute or so. Israel working to allow civilians to leave through the Rafah crossing out of Gaza into Egypt. It was unclear yesterday whether that's all civilians or foreign nationals. Ollie, have you got any clarity on that whatsoever this morning?
So the focus is going to be on foreign nationals. I think that there is this huge question of refugees, and this is completely, this for Egypt has said basically is a non-starter. The Jordanians have said this is a red line. We will not take refugees. So this is going to be another part of this very complicated puzzle. And the question is, yes, on the one hand, it's overburdening these societies that maybe cannot take a huge injection of refugees. But again, this is at the very heart of this issue. It is seen as relinquishing territory and moving people from their homes into another country. That is just not acceptable for many of these leaders.
However, does the president have an agenda or a White House schedule where we know when he leaves? Is this a structured trip as usual, or are they making it up as they go?
We certainly get the sense that they're making it up a little bit as they go. Again, this was going to be a much larger and longer trip that had this Jordanian component that now is evaporated. We do not expect the president to stay overnight in the region. But again, as we've seen with Antony Blinken and all of his movements over the last 5 or 6 days, this schedule has moved and has been very fluid throughout this. Olaf Scholz was here yesterday. He went to Egypt himself to try to do some of that diplomacy. Again, we do not have that expectation, but I would say that everything is on the table.
Ollie, let's talk about the military deterrence. There's a growing presence in the Eastern Mediterranean now. Can you walk us through what we heard yesterday about the kinds of numbers that the US has got on standby?
So what we've heard is 2,000 troops that are on high alert. And again, we have 2 carrier groups in the Eastern Mediterranean, which are, some of the biggest carriers that the U.S. has to offer. So again, in terms of deterrence, this is going to be absolutely huge. But again, it's going to be providing military aid to Israel. As we hear every single day, you hear the Iron Dome going and taking rockets out of the sky. That has a limited supply of ammunition. We know that the U.S. has given some of their own stockpiles back to Israel. But there's also this question of Hezbollah. If they do get involved, they have an unknown number of thousands and thousands of rockets stationed in southern Lebanon, deep underground. They could also, if they fire many of them at once, could overwhelm the system. So again, this is the great fear of escalation here in Israel. And again, this is the situation that is made infinitely more complicated by the explosion in the hospital yesterday.
Ollie, thanks for being with us, sir. Ollie Crook on the ground in Tel Aviv. The President of the United States could well be speaking in the next several hours or so. A quite shocking incident in the last 24 hours. The back and forth, trading accusations, Hamas blaming Israel, Israel pointing to a video of what its military said was a malfunctioning rocket shot by Palestinian militants. The pressure that will be on Israel now, Tom, to provide evidence for what they're suggesting in the last 24 hours is going to be absolutely immense.
Ira Duffner's been policing this, and by policing I mean the language, the rumors, the speculation. And what's interesting to me today, John, X number of days into this, is the phrase Islamic Jihad has entered the discussion this morning. I'm not sure that was there 3 or 4 days ago for most of us.
Well, this is sort of this question around how many proxy agents are there in the region that are being funded by Iran and that are connected, and that they are different factions. There is a sort of feeling that there are more people involved. Question that I have is, what is the trigger point for something that really is going to spiral into a new frame of mind? And you are seeing that a little bit, the fears of that this morning.
Really unsettling this morning. Getting reports from AFP. Thank you to our team over in Brussels. Maria Tadao sending this one over. 6 airports in France, Tom, evacuated after attack threats.
I think across continental Europe, of course, closer to Israel, this is going to be a theme here. And let's not kid ourselves. This is in the United States as well. Maybe it's hidden, maybe it's out of picture, but I think all intelligence communities of every persuasion are hyper-focused this morning. It's folding into the markets as well. I'm looking at the screen, John, and with the president in Tel Aviv, there's a new tension on the Bloomberg screen.
Equity's a little bit softer. We're down 1/3 here. If you want to find the tension in the commodity market, through the 90s on Brent, 92.42, up by 2.8%. WTI crude, 89.23, up 3 percentage points. With us now is Ben Laidler, global market strategist at eToro. Ben, deeply disturbing pictures in the last 24 hours, for that matter, for much of the last 10 days. Ben, when you look at the market, there is a belief that maybe this can remain localized. It's something that perhaps investors can try to ignore. Ben, is that the wrong approach to this situation?
Yeah, this is obviously a terrible human tragedy. And from a market perspective, anytime you see rising economic and geopolitical uncertainty, which is what we're seeing now, that is bad for markets. It saps investor confidence. It saps company confidence, and we're just bad at pricing it. And it's coming at, on top of that, a vulnerable time where a flux on the earnings cycle, a flux on the economic cycle, a flux on the interest rate cycle. So all that, I think, is ingredients of worry here. The only non-negative thing I can say about this is these high levels of uncertainty have unfortunately become a new normal over the last few years, whether it's the Ukraine invasion, whether it's the dramatic backup in inflation and interest rates that we've all endured over the last couple of years. So I think the market reaction you're seeing, whether it's stocks not selling off hard or whether it's haven assets not rallying maybe as much as people think, is unfortunately we've just got used to these very high levels of uncertainty in the last few years.
So are you saying, Ben, that because people have gotten used to high levels of uncertainty, there isn't going to be a big asset repricing as a response?
I think that's the scenario that's played out so far. I'm not the geopolitical analyst. Obviously, there's huge flux, huge uncertainty. Things could, easily get worse here. But I think that explains the situation so far. I guess the one thing I would just say, oil is the key worry point here amongst the sort of assets we look at. And I just, a little bit of context here. This is not the 1970s. Our economies are 60, 70% less energy intensive now than they were back then. Gasoline's 3% of the inflation basket, 4% of the stock market. It's a big deal. I'm worried about it, but I do think it ultimately self-corrects. Right, every dollar you go over $90, I think, is everyone's trying to use less oil, and I think our economies are just different now than they were 20, 30 years ago.
That said, Goldman Sachs came out overnight basically saying that markets are not accurately pricing some of the risk out there. A team at Goldman Sachs saying a prolonged period of geopolitical uncertainty coupled with still inflationary macro environment is likely to eventually trigger growth concerns. On the margins, are you taking off some risk in light of just the heightened risk scenario that we have on the table right now?
I think we're in an environment where you need to be invested, but you need to be reasonably cautious. Geopolitical risks are rising, and that's not good. $90 oil, bond yields where they are, none of that's good. Ultimately, though, I do think we should be focusing on the bigger picture, which I think remains reasonably constructive. The interest rate cycle is coming to an end. Inflation is easing. I think economies are going to start are almost as good as they're going to get. And I think the earnings cycle is troughing, and I think you're going to get some sort of technical tailwinds, if you like, from seasonality and investors who are already very cautious. And I think that's the other ingredient here as to why markets haven't reacted, more negatively. Is investors have had 3 to 4 months here to take risk off over the summer. I think and you've seen quite a lot of that.
Hey, Ben, good to catch up. Ben Lader there of eToro, constructive on this market. We've talked about this a few times over the last 2 weeks. The challenge of processing seemingly two opposing thoughts simultaneously. You can have a bank CEO turn around and tell you it's the most dangerous the world has been in decades, and the very same bank CEO, Bramo, can boost their guidance and deliver better numbers. That's the challenge for investors looking at this situation currently.
And this idea that the emotion of the moment is incoherent with the cold-hearted nature of markets that are trying to game out probabilities. The problem is when you do have a level just hanging over your head for a prolonged period of time, where you have such explosive types of scenarios in a really key region, it takes its toll. And that's what I'm starting to hear from a certain number of notes, whether it's Goldman Sachs strategists, whether it's also what we're hearing out of Bank of America. So these are some of the things that I'm watching. It's hard to just ignore it.
We'll talk more about that Goldman note a little bit later in the hour. Looking at this market right now, this bond market absolutely punishing. We were told that yields at the front end were pinned, and then they weren't. On a 2-year, up by 11 basis points yesterday through 520. Right now, your 10-year yield 482.80. The story continues. Leslie Vinger-Murray of Chatham House coming up next from New York City. Good morning.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
Haley, everything has changed. One could make the argument that the president was going with a significant amount of political and moral capital for having taken a very unambiguous stand on the question of terrorism and Israel's right to defend itself. In preparing for this trip now, you have the backdrop of a horrific event at the hospital in Gaza. The trading of blame doesn't change the fact that hundreds of people have been killed.
That was Daniel Kurter there, the former US ambassador to Israel on balance of power. Arguably the most difficult trip the President of the United States has been on its tenure in the White House. The blame game continues. Hamas is blaming Israel. Israel is blaming the other side. This line from Israel Defense Forces: a failed rocket launch by the Islamic Jihad terrorist organization hit a hospital in Gaza City. IAF footage from the area around the hospital before and after the failed rocket launch by the Islamic Jihad terrorist organization that was posted on Twitter, on X, formerly known as Twitter. Lisa, the pressure to work out what has happened here and the intensity of this trip, I cannot really convey how difficult this moment is for the president. It was hard enough to begin with 24 hours ago. It's that much harder now.
Especially with the protests that have been percolating out in the region and beyond. The scenes from Beirut last night were pretty dramatic. There is also a question about whether the stances of Egypt and Saudi Arabia are shifting based on statements that they put out, very much taking a side and saying and blaming Israel for this. So it raises the specter of how much harder it's going to be for President Biden to get some sort of ceasefire and agreement when the lines are hardening in the wake of such emotion.
I just can't go to a ceasefire yet. I think we're miles and miles away from that based on what the Israeli military is going to decide to do, to choose to do here, perhaps when the president leaves and beyond. But I see a lot of diplomacy going on right now, John, and not enough talk about the military as we did yesterday with James Stavridis.
Well, the headline, Tom, is the diplomacy that's not taking place in the next 24 hours. Initially, this was supposed to be a two-part trip.
Yeah.
One part Israel, second part in Jordan. Almost immediately in the hours after that blast, King Abdullah, Abbas, al-Sisi of Egypt, all cancelling that trip. That was a key part of the reason, the objective of making this trip to begin with.
For most of our Americans not familiar with this geography, the West Bank is actually to the east. It's the West Bank of the Jordan River. And John, what's so important here is the analysis in Israel is about what should have happened, of course, what is happening, what should happen forward. And it centers around this West Bank, and that's buttressed up against Jordan.
If you are just joining us, welcome to the programme. I'll just set the tone for the markets currently. Negative by a third of 1%. No drama in the equity market on the S&P 500. Plenty of drama in the bond market yesterday. Yields up by 11 basis points at the front end through 520 rather on a 2-year. Right now about 518. At the moment 482.80 on a 10-year. Yields down by a single basis point or so. We do have a rally in crude. WTI is getting closer and closer to 90. 89.24 on WTI. Brent crude, Tom, 92.50.
I want to point out, John, very importantly, and this is for the sophisticates out there, Euro Swissy again goes through 0.95, which shows strong Swiss franc, and that is really a tea leaf of the tension that is out there. Joining us now, someone quite known at Chatham House for clarity of thought, Leslie Vinja-Murray is head of U.S. and America's program in London with a truly global view. Leslie, I have to go to one of your recent essays. Everyone in your world is writing, thinking, looking back, looking forward. You look back in one of your essays and say America went off the watch in the Levant. What did we do wrong?
I think that there was a sense that with the withdrawal from Afghanistan, as tough as that was, that America could really focus its priorities very clearly, very strategically on China. That was, first checked by Russia's invasion of Ukraine that brought America squarely back into the Euro-Atlantic and with full force through NATO, really working to support Ukraine. But there was a hope, and there's been a hope for a long time. There was a belief that this was a president who had finally executed on that intention of so many American presidents to really reduce America's footprint in the Middle East and to focus on those strategic priorities. And number one was China. And this has just shown in spades that America is an essential power. We've had China at its 10-year anniversary of the Belt and Road Initiative talking about economics and economic diplomacy, completely completely silent on the question of the war. So I think it's very clear with President Biden's trip and this ongoing diplomacy, this is very difficult for the U.S. Perceptions across the Middle East of America's power in the present and in the past are very complicated, but it certainly demonstrates that the U.S. needs to stay engaged.
We're just talking here about the military exercise we believe to come. We don't have reports of that yet, really, folks. But Leslie Vinjamuri, to borrow from Fareed Zakaria, in a post-American world, what does a post-Hamas world look like?
It's very difficult right now to imagine a post-Hamas world. I think that is certainly an objective. As you've said, and I noticed your comments earlier, we're very far off a ceasefire. It's widely expected that when President Biden leaves the region, there will be a ground invasion, that is going to be very difficult in a context of urban warfare, but that objective is to root out Hamas. We are looking probably at a devastating loss of life for Palestinians on the ground, and there is no good alternative. And this is the real challenge. We know that that Fatah has not demonstrated an ability to govern. There can't be a vacuum. Israel can't take over Gaza. There's nowhere for the Palestinians to go. And the problem now is who governs in Gaza if and when this crisis, this war is brought to a close. That's a very long ways off right now, but that is where the strategic priority has got to be.
Leslie, how much more difficult is it to get to some sort of agreement in the Middle East, some sort of diplomacy for President Biden based on some of the rhetoric out of the governments of Egypt, of Saudi Arabia, nations that previously might have been more amenable to working with President Biden?
Well, this is clearly the great tragedy. There was that push to really put together an agreement, a relationship between Saudi and Israel. Now, governments across the region are going to be contending with public pressure, grievance for Palestinians who will be and have been killed. And that just makes it much more difficult not only to engage on this question of a ceasefire, of putting together some sort of regional peace initiative, but to be seen to be doing this in the context of a massive loss of civilian life. And this is why we're seeing President Biden in public, behind the scenes, working back channels. There's an effort to get some sort of resolution tabled at the UN Security Council, but really a really strong push and an uphill battle right now to have humanitarian corridors, talks of safe zones in Gaza, trying to get humanitarian aid through. There's been a push to get that Rafah crossing open. These are all tremendously difficult things to achieve, even in the best of circumstances. This is very far off the best of circumstances.
Particularly unnerving yesterday evening, Leslie, to see the protests erupt across the Middle East. In expected places, Lebanon, Tunisia, to see them erupt in NATO's Turkey. Leslie, can you talk to us about that relationship between Turkey and America currently?
This is a very difficult circle to square. Turkey is a vital partner to the United States. It's a member of NATO. But when you begin to talk about Israel and Palestine, the politics are just very different. America is clearly a supporter of Israel. That very close relationship has the effect of alienating people on the Palestinian side and making that prospect of bringing even some of America's closest partners on board to work for what will be vital now. But again, as Tom said, we are so far off that prospect for peace. The question now is, can there even be a significant effort to protect civilians, which is what the president is trying to articulate, what many people are trying to call for, but it looks very difficult in the current context.
Leslie Vinjamuri of Chatham House. Equity's doing okay this week, up on Monday on Tuesday, just about unchanged on the S&P 500. This morning, we look like this on equities. We're negative 0.4% on the S&P. We're down 0.5 on the NASDAQ. We're doing okay, even in the face of this in the bond market. Another big day in the bond market yesterday. This bond market, I said it before, I say it again, absolutely punishing. You get comfortable with the front end of the curve. You start saying things like, we're pinned here. The Fed's not going to go anymore. They're out of the game. Then the data brings you back in. Yields are lower by 3 basis points today, up big time in yesterday's session through 520. This morning, Bramo 517.76.
Megan Graper yesterday nailed it, I thought, of Barclays, where she basically said people might be misinterpreting this idea that the longer end of the curve is doing the Fed's work for them. Maybe it's indicative of stronger than expected economic data that will require the Fed to do more. And yesterday, that was the tone that we felt certainly at the front end.
Justin Wolfers, who we visited with in Jackson Hole, had a blistering note out this morning, John, and I'm paraphrasing to use the Australian. He's looking for a big figure GDP. And that's been just simply keep it simple. We've got a huge geopolitical crisis on our hands. You know what? We've all got wrong. The recession call.
I know the US consumer. We led with it yesterday. The economist decried recession. That recession just hasn't happened yet, and they're still crying recession, and people have stopped believing it based on the price action we saw yesterday in the bond market. 10-year currently, 480-280. Yields just about unchanged there on the 10-year. Just to turn to foreign exchange, we'll finish on the euro for you. The euro against the dollar shaping up as follows in the currency market. 105.57. That currency pair negative 0.2%. A quick look at crude, a rally up by 3% on Brent to 92.62. On WTI, up 3% to very close to 90, 89.40 right now on WTI crude. Under surveillance this morning, President Biden touching down in Israel just hours after an explosion at a hospital in Gaza killed hundreds and left the conflict at a delicate point. Hamas blaming Israel, Israel blaming the other side. Saudi Arabia, Turkey and others condemning Israel. Biden, Lisa, saying he's outraged.
I was deeply saddened and outraged by the explosion at the hospital in Gaza yesterday. And based on what I've seen, it appears as though it was done by the other team, not you. But there's a lot of people out there not sure. So we've got to overcome a lot of things.
Lisa, it's the other side.
This is an incredibly tricky moment. And I have to say, last night was an indictment of how quickly information moves and how quickly social media takes it to another side before there's anything conclusive. My question really is going to be, how much further does this push away President Biden from the leaders of Saudi Arabia, of Egypt, of Qatar, that were on the front lines of trying to come to some sort of agreement, some sort of working relationship? And it seems like those fissures have only gotten wider overnight. And this, to me, is the big threat. It is a powder keg. I keep saying that, of emotion, and you could see that in real time last night and this morning.
Yeah, but I'm going to say that all of that is true, but these were first conversations with people with a legacy of dealing with the Palestine Authority or the three shades of Palestine that there is. I think one of the great problems here is we always frame out back to biblical times that a war is going to be short. And I don't think, can we put a timeline in the military exercise of Israel now in the Gaza Strip towards the West Bank and up towards Lebanon and Hezbollah? I'm not willing to put a timeline on it. And the diplomacy, to Lisa's good point, is out front, verbal, visible, but I'm not sure what the efficacy is other than that thing of diplomacy, John, to just keep talking.
Duration, breadth. I've got no idea.
No idea.
Absolutely no idea. I don't think anyone does right now either. Another vote due this morning as the wait for a new House Speaker drags on. 20 GOP holdouts withholding their support for Jim Jordan, the Trump-backed ultra-conservative. Another vote scheduled for 11 a.m. Eastern this morning, but some Republicans already suggesting Jordan's campaign is heading in the wrong direction. Shout out to Terry Haynes of Pangea. Terry Haynes, 2 Mondays ago, basically just turned around and said, anyone who thinks the odds of selecting a speaker have just gone up because of problems abroad, they're wrong.
What I think is going to be really interesting is at 11 a.m. today, what happens if Jim Jordan gets fewer yes votes than he got yesterday, right? I mean, this is actually a very real possibility because a number of representatives who voted for him yesterday have said they're going to switch their vote to no. Talking about dysfunction, who's next? Who is even on the table as a potential successor to want to put their name up to be pilloried and shot down? I mean, that's essentially what you're trying to do.
A centrist Republican who, name escapes me right now, I'm so sorry for that, I'm supposed to remember this stuff, just basically said he can't fathom the gentleman from Ohio trying to find a middle ground with Republicans or a middle ground with the House of Representatives under some form of domestic or international crisis. I thought that was a nuance of, like, why is this happening, particularly for our international audience?
So there's two stories here. Escalation abroad, dysfunction at home. And I think this third story speaks to both. Escalation abroad, dysfunction at home, and we've got a bond market issue, a major bond market issue. Treasuries yesterday absolutely tumbling. 2-year yields, 17-year highs, following that jump in retail sales, leading to increased speculation all over again that this Fed might have to come back into the game. Year to date, remember the start of the year, this was meant to be the year of the bond. The year of the bond, Brammer, we talked about it repeatedly.
That worked out.
2-year, up 75 basis points this year. 10-year, up almost 100 basis points. 30-year, up 98 basis points this year.
Something that Priya Misra of JP Morgan and Stephen Major of HSBC said that really is kind of haunting me, which is there are a lot of people who believe in the bond story, and yet they're being forced to sell on the margins as people realize some of these losses, as people diversify. What happens if you get actual withdrawals in response to some of these losses from the bond portfolios, and suddenly people who even believe in long-term yields going lower are forced to sell into weakness amid a buyer's strike? Are we seeing that right now in market action that is incredibly jumpy and jumpy to the upside?
I'm with you. The president says we can afford it. Treasury Secretary Janet Yellen says we can afford it. It's getting more expensive based on the moves we've seen over the last few months.
The Bloomberg Total Return Index, the one I follow, the street follows, is only 1.4% down in price, John, to get to the low of the autumn of last year. On a real basis, we're already way beneath that because of high inflation. What I would point out, I went to the Bankrate website and I really looked, and you've got 7.9x% mortgages, and the refinance rate for housing is now over 8%.
Wow.
Yeah, wow was my response. We're very sophisticated about that.
That's all I've got for that. Wow. It's just a wow number, isn't it? It's massive.
We're
so
back,
expensive.
You know, we're going to get to our good guest here, but we are back, John. Forget about the 06, 07 analysis. You can take this back pre-Volcker, back into
We
the
were doing this with
60s.
Shanali yesterday, Tom. Go through the Bank of America earnings and look at some of the origination of loans, mortgages, all of that stuff.
Right.
And look at the credit rating of the average borrower now. They're lending to people with super, super high credit ratings. Never mind paying up for it, being able to afford that price. Can you get access to that price to begin with?
Well, access to capital, and that's when I say the Wayland silence, that's precisely what we're talking about, is where there's a silence to those of a more mortal credit. What we're going to do now is go to Jennifer McCown, Chief Global Economist at Capital Economics. We thank you for being with us on radio and television. We are watching with Oliver Crook in Tel Aviv, news flow from Tel Aviv, and we'll give you a complete report on that as we see it in the coming minutes. Jennifer, there is a geopolitical crisis. How does it affect your economics? How have you adapted your Excel spreadsheets to a war in the Eastern Mediterranean?
Well, it is very difficult, isn't it, to incorporate these kinds of events into economic forecasts, not least given the uncertainty about the extent to which this might escalate, concerns around commodity prices. But those are the things that we're considering, really. We've not changed our commodity price forecasts at the moment. We'd already expected oil prices, gas prices to remain relatively high out to the end of the year. But there are certainly risks around that we're very much focused on, and the potential implications for inflation elsewhere.
Brent crude, folks, up 3%, 92.69, nicely above 92 right now. Jennifer, I noticed a statistic. John Ferro mentioned it to me, and he's looking at his Kensington real estate, and that is 6.7% inflation in the United Kingdom. Are other central banks going to see those kind of statistics where they have to go longer or even, dare I say, higher because of persistent inflation?
Well, yeah, that's a real concern for the UK, and a bit of a disappointment, that 6.7% rate. I guess the encouraging point from the UK's perspective is that the labour market does seem to be loosening a bit, and that's really been the key for the UK, the extreme strength of wage growth, which now does seem to be coming off a bit. For other central banks, the Fed, the ECB, inflation's not so high. Core rates are clearly coming down, particularly if you exclude shelter in the US case. So less cause for concern in those economies, I think. And a big point to note is that so far as central banks are concerned, the rising bond yields that we've seen is doing some of their work for them. So if anything, that would maybe make them less inclined to hike further.
Jennifer, to that point, this idea of higher borrowing costs around the globe, how much does that really strain the ability of governments to be able to keep borrowing in the face of growing geopolitical tension, akin to what some people are saying is the worst going back 50 years? The U.S. is talking about possibly a $10 billion package for both Ukraine and Israel. Is that plausible without another leg higher in borrowing costs?
Well, the current policy plans, yes, I think are plausible because they're already priced in to the market to some extent. But certainly the high levels of borrowing costs are going to limit government's ability to provide further support. We're certainly expecting in the future for them to have to consolidate to some extent and rein in their borrowing.
Right now, what are you looking at? Basically get a sense of just how closely tied the global outlook is to some of these risks. And I ask this because we have Bloomberg Economics coming out and saying that if oil prices surge to $150 a barrel, that you could see the global economy tipped into recession. How much are you adjusting some of your parameters in light of the recent developments?
Well, as I said, we'd already expected oil prices to remain relatively high out to the end of this year, gas as well, but we're keeping a very close eye on the situation, whether it escalates. And I think that's what you'd need to see for those kinds of $150 per barrel numbers that you're talking about. We'd need to see some escalation to broader parts of the region, to elsewhere in the Middle East, to see those kinds of high levels. And yes, if that were to happen, then we would need to revise up our inflation forecast significantly. It may be that central banks in developed markets would need to hike further for fears that this starts to affect core inflation, and then recession risk clearly intensify at that point.
Jennifer, one final question too quickly here I should say. What we have new is an inflation adjusted yield that's tangible, a tangible real yield. How does a tangible real yield fold into your GDP forecast for any given nation? On the consumption side, and particularly on the business investment side?
Well, what we're looking at really is the pass-through of these yields into effective borrowing costs. We know that the pass-through has been relatively slow, partly because of a shift to more longer-term debt, particularly in mortgage markets in the developed economies. So the effects of the policy tightening that we've already felt have not been felt by the average households in particular, and firms too. So we're looking at the extent to which that is passing through in future. We've seen financial conditions tighten pretty dramatically and lending come off, new lending, and effective interest rates are now starting to rise. We think maybe we're about half of the way through feeling the effect of the policy tightening that's come. So we're looking at the remaining half and the extent to which that starts to really hit consumer spending, for example.
Jennifer, thanks for being with us today. Jennifer Mickione there of Capital Economics. Story worth monitoring. Just another headline crossing a Bloomberg for you. This comes from Le Soir, which is a French-language Belgian daily newspaper. The headline reads that the airport Ostend in Belgium evacuated after a bomb threat. Unfortunately, Tom, we've seen several of these headlines over the past few days.
Well, we have. In Belgium, of course, is a tinderbox of Europe in terms of terrorism. I think that's widely understood. But it's part of where we are, and I'm quite confident, John, we'll start to see some of this in America as well. We're not, the ocean does not protect us this morning.
A super fluid situation on the ground in Israel this morning, where the President of the United States is, alongside the Israeli Prime Minister Benjamin Netanyahu. Any comments that come out of that meeting throughout this morning? If we get a briefing, we'll bring those headlines to you. Coming up shortly, Devon Ryan of JMP Securities on bank earnings. Morgan Stanley, the final bank out of the gate to wrap up earnings on Wall Street before our attention turns to tech after the closing bout, with Tesla and Netflix on deck. From New York City, futures down. This is Bloomberg.
Frankly, the Fed has won the battle with the American consumer, and they're slowing down. And then the question is, What happens next, I can't predict, but this is a $4 trillion base, $300 to $400 billion a month. So think about it. It's hard to move around a lot. So once it slows this level, it's probably not going to kick right back up.
Really interesting interpretation of what's happening with the American consumer there from Brian Moynihan, the Bank of America CEO, speaking with Bloomberg's David Westin just yesterday. The retail numbers suggested the consumer boom continues. Brian Moynihan is talking about a slowdown of his clients, his customers. We talked about this yesterday, Lisa. Is Bank of America still the bank of Americans?
Based on the FICO scores that they have, no, I don't think so. I mean, they basically are perfect. There's also a larger question around him saying, yes, the consumer is slowing. But we talked about this yesterday. To what? He still said that total spending, was up year over year from last year. So we are still dealing with elevated spending levels. Are we going back to just a higher or a lower high rather than just basically the normal numbers of the past?
Healthy but slowing. Can we give a shout out to Barclays yesterday? Came on this program and basically said, perhaps this market's got it wrong, that if this data continues to surprise to the upside, the Fed might have to come back into the game. Based on the price action we saw yesterday following retail sales, I'd say Barclays had maybe, Tom, picked up on the scent of what was just around the corner.
I agree. There's a huge economic readjust off of the combination of the jobs report and what we saw yesterday with buoyant retail sales. And there's some people out there quibbling, saying seasonally adjusted. There's some challenges. But the fact is the markets are in charge, and the markets spoke with a vengeance yesterday. There's no other way about it. One thing I would point out as we go into Morgan Stanley analysis, John, and I've seen a number of market cap studies. The great unspoken here is how J.P. Morgan quietly, quarterly to quarterly, extends its lead. That's what's really not being talked about, is on a market cap basis. It's not fair to say it's them and everybody else, but the tendency's there, the trend is there.
I think the stock outperformance speaks for itself on that front. If you are just joining us for the price action, we're negative. Session lows actually by 0.5% on the S&P 500. Yields just about unchanged, 482.59. Getting really, really close to 90 on WTI, 89.25. We're positive there by about 3%. Plenty of bank earnings this morning, TK, including the regionals as well. Bancorp, First Horizon, out just moments ago.
Those are really important. The regionals are key, and as we heard from Thomas Schott of Keefe, Bruyette and Woods yesterday, the smaller banks making up 90% plus of the pie. Right now, though, the focus in New York on Morgan Stanley, Devin Ryan, Director of Financial Technology Research at Citizens JMP Securities, joins for a brief this morning. Why does Morgan Stanley have such a price to book value differential over Goldman Sachs? What is the distinction, Devin?
Hey, Tom, good morning. It's really simple. It's the wealth management business. Typically, investment banks, particularly balance sheet investment banks, trade on book value, and wealth managers trade on earnings. And so Morgan Stanley has a much bigger wealth management business and investment management. So that's been a good story for them. I think today the big question, interestingly, is going to come back to what's going on with net interest income within wealth management, because that's been such a tailwind for Morgan Stanley. We might see that flip a little bit this quarter. So interestingly, that's where everyone's focused here.
But they're not Charles Schwab, right? I mean, their net interest income is a different NII from Schwab.
Different and similar. So it's driven by the customers in the wealth management unit that sweep cash over to Morgan Stanley's bank. Similar to Schwab, the difference is that Morgan Stanley on the asset side of their balance sheet has more of a floating rate dynamic. So that's been good. But the negative side has been that they are losing kind of some of that low cost deposit, and that's going to higher yielding options like money markets and CDs. And so that has been a little bit of a story, but Morgan Stanley has seen a huge tailwind to the tune of about $2 billion over the last couple of years, simply because interest rates have moved higher and they're earning more on the asset side of the equation than what they're losing on the liability side.
I usually don't go to the soap opera side of it, but Sonali Basak insists that I ask this question. Is James Gorman going to make a succession announcement today?
I don't think it's coming today, or at least they haven't set us up for that, so I'd be surprised. But Gorman's done a fantastic job, and they have a deep bench, so we're pretty comfortable with the direction that it may go. But you have to give him a lot of credit for how he's navigated this company.
Devin, usually the regional banks are sort of a side note to the bank earnings, and this time I'm actually more interested in the regional banks than I am the big banks, which seems to be doing just fine and insulated for a whole host of reasons. So far this morning, we got data from Citizens Financial that showed that net interest income, net interest margins came in below expectations. Those shares are tumbling. How much are regional banks going to really tell the story as big banks cater to an increasingly select group of wealthy individuals?
Yeah, I think it's a great question. I think this all comes back just to what's going on with interest rates and the question of, is the Fed done or is the Fed still moving higher? And it's creating a lot of uncertainty with funding, with deposit bases. And to the extent, the Fed is done or interest rates eventually start to move back down, that'll be very settling for, the broader banking industry. To the extent rates are still moving higher, it continues to put that pressure on funding and ultimately, to your point, on net interest income. So that's where this push-pull is right now, and that's we're all focused on it. The macro is much more relevant right now than in a lot of cases these individual companies, and that's driving the story.
Well, to build on that, how much did the big banks of Wall Street really tell the story that we're going to see in some of the smaller banks? How much is the divergence really clouding any kind of macro signal from big bank earnings that we used to get?
Yeah, well, again, I think the big banks have a pretty diverse business, and areas like wealth management at Morgan Stanley, or even trading at firms like Goldman that did incredibly well this quarter, are less of a story for more interest rate driven firms. And so, as rates remain kind of this big question mark, and to the extent we stay higher for longer, that creates some pressures. The flip side is that in our opinion, a lot of that money that would have moved, the yield-seeking money out of the banking system or out of the brokerage system like Morgan Stanley, has already moved because rates have now been high for a sufficiently long period of time that if you had money that you were going to move, you likely would have moved it. So I think we're still dealing with the same issues we've been talking about for the last year, but I think they're less intense. The question is, do we have another step function higher in interest rates, which is, again, I know you guys were talking a little bit about that this morning, that becomes another potential risk. And you could take it on the other side and say, if we're stabilizing, then then the whole system stabilizes. But the uncertainty for financial investors is the biggest thing that people are dealing with here. It's not healthy for financial investors.
Devin, very quickly here, everybody wants to do what Morgan Stanley's doing. I really never seen it in my life. Everybody wants to be in wealth management. But it's got to be some form of zero sum where only some selected people win. Who's losing right now?
Yeah, it's funny, Tom. There's about 300,000 financial advisors in the U.S. Today. There's about 300,000 financial advisors in the U.S. 20 years ago. So it's not this huge secular growth industry in terms of new advisors coming into the market. So it is really zero sum, as you mentioned. There's always, not to kind of pick on companies, there's always kind of net share losers, particularly some of the larger firms. I think Morgan Stanley's been a winner. And then, there's a big shift actually to independence. So financial advisors kind of leaving even some of the wirehouses and going and running their own book of business at a firm like LPL or Raymond James, or even custodying with firms like Schwab or Fidelity, which is why you've seen such tremendous growth at those types of firms. So there is a lot of movement going around, but it is zero sum. So Morgan Stanley's been a winner of the big firms. It's also a scale game. So firms are going to have a hard time getting into and breaking in because it's such a scale marketplace.
Hey, Devin, got to leave it there. Devin Ryan at JMP Securities, going into numbers from Morgan Stanley in the next hour or so. Super fluid situation on the ground in Israel, where the President of the United States is meeting with Israeli Prime Minister Benjamin Netanyahu. Let's try and listen in and see if he answers any questions. A closed-door meeting with Prime Minister Benjamin Netanyahu and the President of the United States set to commence any moment now. The President is in Israel. He will not be going to Jordan for the summit with Arab leaders, including Egypt, the Palestinian Authority, and Jordan as well. We were hoping, Tom, maybe for some comments from either leader.
The symbolism is shocking. I have to admit, I'm taken abruptly, folks. For those of you on Bloomberg Radio, here's the president, I believe, speaking. Let's listen in.
Israel seeks to minimize civilian casualties. Hamas seeks to maximize civilian casualties. Hamas wants to kill as many Israelis as possible and has no regard whatsoever to Palestinian lives. Every day, they perpetrate a double war crime, targeting our civilians while hiding behind their civilians, embedding themselves in the civilian population and using them as human shields. We've seen the cost of this.
The resilience, I think, has taken a lot of us by surprise.
We are seeing the drag from higher prices weighing on consumers' ability to spend as we move forward.
We've read far too much into recent Fed speak that implied that these higher rates might have actually done some of the heavy lifting.
Is the long end doing some of the Fed's work for them? Absolutely, but that's proving not to be enough.
It kind of feels like we're in a sort of everything everywhere all at once market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Our top story this morning, President Biden touching down in Israel, his trip unraveling before it even started. A single blast at a hospital in Gaza killing hundreds. Israel is blaming Hamas. Hamas is blaming Israel. Tensions already at boiling point across the region. The explosion threatening to tip things further over the edge. The president says he's outraged.
I was deeply saddened and outraged by the explosion at the hospital in Gaza yesterday. And based on what I've seen, it appears as though it was done by the other team, not you. But there's a lot of people out there not sure. So we've got to overcome a lot of things.
The stakes for this trip could not be higher. How do you prevent the conflict from spreading? How do you ensure aid gets into Gaza and civilians are kept out of harm's way? Our team coverage begins right now with Bloomberg's Ollie Crook in Tel Aviv. Ollie, good morning.
Yeah, John, you've outlined a lot of the main issues and the fine line that Biden needs to walk today, in a very different trip, as it turns out today, than what he was planning for yesterday. Initially, this was a two-legged trip, one first in Tel Aviv in Israel, where we were supposed to hear the kinds of messages of support that we've heard from the U.S. administration throughout this entire time. Again, emphasizing deterrence. I mean, right behind me, you cannot see it. It's probably just brightness. That is the Mediterranean Sea, the East Mediterranean, where the U.S. has sent two carrier groups in order to deter any spillover. And of course, right now, as we speak, Biden is in this building just one floor below, meeting with Netanyahu and the war cabinet in order to discuss what the next possible actions are. But then again, the part that we lost of this trip was the trip to Jordan, where he was supposed to meet with the president of Egypt, the King Abdullah of Jordan, and of course, Mahmoud Abbas, who presides over the West Bank. And that part, the diplomacy, is really the key part of this trip. And that is the part that is no longer going to happen.
It's absolutely extraordinary, Oliver, to see the images of the President of the United States and the Israeli war cabinet moments ago, comments by Mr. Netanyahu, comments by Mr. Biden. It was brief as well. What will they actually talk about? Are they briefing the United States on a war to come?
I think that will probably be part of the discussion. And of course, Tom, the focus this morning has been squarely on the last sort of 14 hours, where we had that blast over that hospital in northern Gaza, where now it seems, and this is sort of the main news line to have emerged from Biden as he's arrived here, saying that it seemed as if he believes that it was not the Israelis who were responsible for this, but in fact, potentially there's more credence to this idea that the IDF has been saying that this was a malfunctioning of a rocket fired within Gaza. Again, there is still a lot to be found out on this, so certainly that will be part of the discussion. But yes, Tom, we've been talking about this ground incursion, invasion, all of these sort of euphemisms for whatever will come next on the ground in Gaza from Israeli forces, and I'm sure that is going to be front and foremost in these discussions, particularly when last week Antony Blinken made it very, very clear that yes, they have Israel's back, yes, they have the full support of the United States, but how? The how of how Israel goes about dismantling Hamas is going to be absolutely critical.
And the pressure is only rising. Overnight, over the past 12 to 14 hours, we've seen protests around the world, including in the West Bank, including in Jordan and Lebanon. How much is the feeling on the ground among officials that things are spiraling at this moment versus some of the imagery that we've seen, right? I mean, how much do people sense that you're speaking with?
I mean, what I will say is that you wake up this morning with the headlines that we saw overnight and what happened in northern Gaza, that is, you feel it immediately, and you feel it immediately around everybody, and people waking up and talking about the latest things that have happened. This sends a shudder down the spine of everybody. I mean, if the reports are accurate, according to the Palestinian Health Authority, that's 500 additional dead at this hospital. And again, if you want to get into the nuance of whose fault is it, to a certain degree, that is going to be irrelevant to certain actors here. And we saw that anger and that fury on the streets across the Arab world, in Turkey and Lebanon. We saw it in Jordan and in the West Bank. And again, this makes it just all the more difficult, particularly when the diplomatic side of this trip has been basically blown to pieces by the explosion that we had this morning in Gaza.
Ollie Crook on the ground in Tel Aviv. Ollie, as always, sir, stay safe. A deeply uncomfortable tension hanging over that region over the last 2 weeks or so. Joining us now to continue the conversation, Bloomberg's Maria Tadeo over in Brussels. Maria, several reports indicating there are several attack threats at several airports across the continent. What's the latest?
Well, Jonathan, this continues. And again, it speaks to some of the tension that we've seen already play out. And the situation now in France is that a total of 6 airports have been suspended, the operations there, because of a bomb threat, and that is being investigated. On top of that, you have to factor the situation that took place here in Brussels 2 days ago, a man who shot 2 people on the streets. And you go back to Friday when a teacher was stabbed in France. Now, you've seen a lot of heightened security across Europe. I go back to the words of President Emmanuel Macron, who did say the terror threat has certainly increased over the past few days, and also this warning that Europe should not import tensions. Obviously, he's talking about the situation between Israel and Hamas, but also even a bigger religious component to this into the continent. Having said that, when you look and speak to officials, they all say clearly they are worried, and obviously they pay extreme attention now to national security when it comes to potential terror that may play out.
Over the initial days after the attack on Israel by Hamas, there was a lot of support from European officials for Israel. Recently, we've seen a number of participants really come out in critical sort of tones about Israel. How much is that support waning, or how solid is it at a time of a very fraught tension across the region?
Look, it's a very good question, because it also speaks to the different dynamics and the sensitivity across European countries. Now, would they all agree? And yesterday, remember, there was an emergency meeting by European leaders, is that they stand with Israel when it comes to the terror attacks that they took place. Today, the head of the Commission, von der Leyen, repeated it is Hamas that has unleashed this terror and a new spiral of violence. The issue, however, has to do with the people of Palestine and the level of humanitarian aid that will be provided to specifically Gaza. You have countries that say immediately they need to let in the humanitarian aid. The other point here is that for the Europeans, they say the issue at hand now is that you have a military operation that is taking place in a place that is very densely populated. The people need to get out. And it is very important to stress here that the key in the eyes of the European Union is Egypt. The problem, I'm being told by European officials, is that the Egyptians are very concerned about opening corridors into the country, because they fear, A, they're going to get an incredible number of people, so a mass exodus of people, and then this is not going to be a short-term situation, but could be a permanent settlement. And it's a country that is under enormous economic tension. So you see there's a lot of factors playing into this.
Maria, all of this is symbolism. For those of you on Bloomberg Radio, as the president and Mr. Netanyahu met, there were American flags and Israeli flags over the shoulder in the background of Mr. Biden, and Mr. Netanyahu, Maria, had only Israeli flags over his shoulder. How alone, from where you sit in Brussels, how alone is Israel right now?
Look, Tom, it's a difficult question, because, again, you go back to the different sensitivities that play into this issue. Now, for the bigger part, the European Union still says Israel was attacked unprovoked, and they have every right to go after Hamas. But it really is about the people of Palestine and the response when it comes to civilians. If you listen to Olaf Scholz, he was there yesterday in Tel Aviv. He points to this idea that Germany has a moral duty to the state of Israel and has to stand with Israel. You look at another number of countries. I'm thinking of the Irish, the Belgians, even the Spanish, who do say at this point there is a level of collective punishment that it is not acceptable. At the same time, Tom, you have to factor the idea that for Europe, this is a very fine line, because on the one hand, they want to be seen as supporting Israel, but they also say that they are the country that obviously aspires to all of this great democratic values. So it's a very difficult thread to walk when you, on the one hand, have to support Netanyahu, who's incredibly controversial in Europe, but also push for a humanitarian resolution to the problem.
Maria, I want to finish on the relationship with Turkey. We saw a series of protests erupting across the Middle East yesterday, in Lebanon, but also in NATO's Turkey. Maria, talk to us about that relationship now. How on the edge? How tense is it?
Look, Jonathan, it's a very good question, because I have to say the language that I've gotten from officials and diplomats now, it's the most severe I've heard in a week. Ever since this started, they really do say this is a region that is a breaking point, and it is a boiling point. When it comes to Erdogan, you also have to factor that he is someone that speaks to different audiences. When you have Erdogan at NATO, it's a very different Erdogan than the Erdogan that speaks to the Turkish people. And now, obviously, he feels he has a responsibility for the Palestinian people. And there is also, I should say, very delicately, but a religious component to this. And on that note, today, the top European diplomat did say that that's an issue that needs to be calmed down, that this should not be played as an interreligious conflict at this point, and that Europe does not want to be almost thrown into this debate where clearly they feel uncomfortable.
Maria, thank you. Maria now over in Brussels on the latest on the continent as we look to the Middle East and the tense situation on the ground in Israel. The President of the United States in a meeting, a bilateral meeting, with his team together with Prime Minister Benjamin Netanyahu and his defence cabinet. The latest headlines from that, we'll bring them to you through the next hour or so. The objectives of this trip. The objectives in some ways, Bramo, haven't changed. They still remain the same. One, how do you prevent this conflict becoming a broader issue that engulfs the whole region? Two, how do you protect civilians on the ground? How do you keep them out of harm's way? It was meant to be a two-part trip. One to Israel, that's taking place right now. The second part to Jordan, as soon as we got news of that blast at the hospital, the explosion that took place in Gaza yesterday, the second part of that trip got blown to pieces.
Off the table, meetings canceled, the summit over in Jordan not existent. So now the question is, have the facts on the ground moved ahead of the planning of this trip? Can he accomplish one of the key components of this trip? If you are having these kinds of conflagrations and these tensions and the powder keg that Maria today was just talking about, we don't know the answer. So now that really focuses on the humanitarian side, the how that Ali was talking about earlier.
The diplomatic challenges get that much harder after the events of the last 24 hours or so. If you are just joining us, here's the price action for you in the equity market. We are negative. Session lows, we're down by 0.4% on the S&P. Yields are a little bit lower by a single basis point, 481.96 on a 10-year. Yesterday, some big moves higher at the front end of the curve. The 2-year back through 520 off the back of a blowout US retail sales report. Really strong data, arguably bringing the Federal Reserve back into the conversation. Now, if the Federal Reserve wants to entertain that, they get plenty of opportunity. Tons of Fed speakers through the next couple of days, including Lisa Chairman Powell tomorrow.
Yeah, the Fed speak just keeps on coming. And today we get a whole host of additional Fed speak, including Fed Governor Chris Waller, New York Fed President John Williams, Fed Governor Michelle Bowman, Richmond Fed President Tom Barkin, Philly Fed President Patrick Harker, Fed Governor Lisa Cook. That's all today and the Beige Book.
That is insane. Well done, by the way.
Thank you.
Nice.
I appreciate it. I'm learning from the best. Yeah, exactly. I was inspired.
It was a Billy Joel moment.
Is that what that was, Tom?
It was a Billy Joel moment.
We've got a lot to get through. The distractions right now. I go back to what we said a little bit earlier. You've got the escalation abroad, the dysfunction at home, can't get a speaker in the House, and you've got a bond market that just will not stabilise. It just won't. The volatility we're seeing in treasuries day to day in either direction, double-digit moves. A lot of people spooked by some of the volatility we're seeing, Tom, in the bond market.
And this core stability here is a rising inflation-adjusted yield. The adults that we have on the show here within this turmoil, this cacophony, go back to, to borrow just a simple phrase, John, the cost of capital, of doing business as a household, of doing business as a truly small business, frankly, of doing business of Procter & Gamble. With their earnings today, the real yield changes everything.
Honestly, I'm just looking at the idea that normally in a time of uncertainty, you get a risk-off move, and that yesterday we've got yields touching the highest levels going back, to 2006. What does that tell you about the moment that we're in and the potential new outlook that people might have to reckon with?
Equities are up on the week. Positive Monday, unchanged yesterday in the face of what we saw take place in bonds. Binky Charter, Deutsche Bank, up next.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
This cabinet came together and standing strong, standing united, and I want you to know you're not alone. You are not alone. As I emphasized earlier, we will continue to have Israel's back as you work to defend your people.
President Joe Biden speaking moments ago in Tel Aviv alongside Israeli Prime Minister Benjamin Netanyahu, standing shoulder to shoulder with the people of Israel. The president's diplomatic efforts getting that much harder following the blast that killed hundreds at a hospital in Gaza. The blame game, TK, this morning continues.
The blame game is going to continue, and the different reports, I think I read Duffer's really solidified it as well around three different themes. We don't need to go into them right now. I think people have early in the morning have identified the horror of this and then the blame game, but I'm not sure how that blame game fits into a beachfront hotel that David Kopensky in Tel Aviv where the president meets with the prime minister. They've got to be focused more on the diplomacy.
That meeting ongoing. When we get headlines from it, perhaps even a briefing, we'll bring that to you. If you are just joining us, equities negative on the S&P 500, down here by 0.4% on the S&P. Yields coming in a couple of basis points, 481. One eye on crude all morning, up by close to 3% on WTI, 89 handle on WTI crude. On Brent, 92.22. Tom, on Brent crude, up by 2.6%.
That's a commodity to look at, and we've mentioned the yield here a lot through the morning. Thank you for joining us, and we will continue to focus on the markets here. But, John, I would look at currency as the litmus paper, and it's a really interesting response. And what I'm watching more than anything, and it was a theme at the IMF meetings, is wither EM. Everybody's focused on the majors, and I'm looking at all the different tea leaves of various middle and lesser countries to see how their currencies play out. Many of them are weaker.
It's a pick up on one major currency pair, the euro against the dollar. 105.56 here, Tom. We're negative by 0.2%. Bit of dollar strength out there at the moment.
Watching dollar yen as well, 149.69. I will call that stability. He is Senior Vice President of Stability at Deutsche Bank. Bikram Chadha joins us now, Chief Global Strategist, Head of Asset Allocation as well. What an urge to go to cash right now, or go to 5.XX% money market fund. Describe how you tell the Deutsche Bank world, don't go to cash.
I think that, if you think about the equity market, you think about earnings, most important, basically fundamental, near and medium term, I would argue. And the story with earnings is a very simple story. They bottomed in the fourth quarter of last year. We've had solid sequential growth in the first quarter, second quarter. We are pretty constructive on what we get in the third quarter. Right. So far, what we've gotten is better than our constructive view, is the way I would put it.
But I went back yesterday, Binky, and I looked at World War II, and I went right for, you can do this on the Bloomberg, folks. You look right from Pearl Harbor out to VJ Day, and it was a nice vector up through the nominal GDP of a war economy and all that. Now, this is not an analog to that, but the emotion is still there. Right. How do you contain your emotion when you're asset allocating with bond price down, yield up?
So I think actually the S&P 500, the market is controlling its emotions, and I think the reason is it understands pretty well what happened the last time around, which is, not very long ago, a year and a half ago, when Russia-Ukraine started, the market sold off. We were down 8%, 3 weeks. We recovered in another 3 weeks, right back to where we were. And so, it just tells you that, by the way, happens to be almost exactly the typical playbook for geopolitical risks and events. And so, given that the market saw this movie not very long ago, it is a bit hesitant, basically, to, do the same thing again.
What we had last year, as you know, was an energy shock.
Sure.
Arguably, in some ways, a little bit more insulated relative to the 70s, given where crude production is in America currently, which is at all-time highs through 13 million barrels a day. The concern now is about America's ability to support these wars. There was a headline yesterday from our team here at Bloomberg that the White House is eyeing $100 billion of Ukraine, Israel and border aid.
Mm-hmm.
Can this country afford those kind of things, given where yields are at the moment?
Yeah, I think that, it still can. I would say that the rise in interest rates and the focus on the interest cost of the U.S. government, which is not high, but what everybody looks at is the projection going forward, and that's what you should focus. So, it's become a talking point. So it's a good starting point for actually discussing the fiscal sustainability of the U.S. I'd say so far, when interest rates were so low, nobody was really talking about the deficit and what needs to be done about it.
You talked about the conditioning of the Russian invasion of Ukraine, the conditioning of the recessionistas that were wrong, and that people are staying put this time around. Does that make this market more vulnerable to an actual pullback in the face of some sort of surprise? Does that make you more concerned about your base case of an above-average rally?
I think the way that you want to answer that question is by taking a look, or through the lens, basically, of equity market positioning. And here I would break up the positioning. There's the systematic strategies, which is rules-based, and then there's everybody else, which is who we call the discretionary equity investors. And, in July, they raised their positioning for the first time in more than a year. I would say, it's really a FOMO pressure. We looked for a pullback. You look at that positioning today, it has come in. It is sitting right back in the range that it's been in since April, May of last year, which is just a little bit underweight. So, a year and a half, there have been plenty of concerns. I understand this is a new concern, of course, but there have been plenty of concerns and shocks over the last year and a half, and they didn't budge. So, I would argue, we were in the middle of a pullback already, so, that's why positioning went down. And so positioning is already basically at or slightly below neutral. What history would tell you is that you don't necessarily want to go underweight here unless, you can time. The playbook would tell you it's really tough because it's 3 weeks and it's big move down, big move up. Yeah.
How much have you changed any aspect of your view over the past, say, 2 weeks, 3 weeks, as we've seen a complete change in the yield regime and we've seen a complete shift in potential geopolitical tensions?
Mm-hmm. I haven't changed my view at all. I would argue, of course, this is a new negative shock, and I would argue it's probably a restraining factor on the upside because risk appetite is going to be a little bit cautious. But the view is based on what's happening with the fundamentals, and I would say so far, the data actually reinforces the view rather than anything else.
I'm looking at Chada, the great Alan Ruskin, young George Saravellos. Take the combination of all your work at Deutsche Bank, and to me, the immovable force here, which is a Lawrence McDonald idea, there's just a pile of money out there to support the bid across most, if not all, asset classes. Is that true that you and I have never seen the $1 trillion pile of money that's got to find a warm place to go?
So I don't really think the equity market performance or resilience is really coming from that. I think it's actually just simply the economy's playing out. You look at yesterday's data where you got this very, very strong response in the bond market. But if you take a look at the data, retail sales, is a nominal variable. So the first thing that you should do is look at it in real terms, which would tell you something about the volumes that people are consuming. Once you do that, the picture changes completely. Retail sales, the real retail sales, were growing in a very clear trend channel prior to the pandemic. The pandemic, for reasons that we all know, caused spending to go up, came down a little bit, went sideways for a while. But for the last 9 months, year, including yesterday's data point, there is nothing to see there. We are just growing in the middle of the trend channel. I think the surprise is that everybody's looking for things to fall. It's a year now. And so, right. I think it's the expectations that are low rather than...
Binky, thank you. Binky Chada at Deutsche Bank. Your equity market on the S&P 500 negative here by 0.4%. Jared Cassidy of RBC on Morgan Stanley earnings up next. Equities on the S&P 500 pulling back. We look like this on the S&P. On the Nasdaq too, negative across the board. On the S&P by 0.4%. On the Nasdaq 100 down by 0.5. On the Russell, we're negative 0.6. The resilience in this equity market, phenomenal. In the face of this in the bond market. This bond market punishing just about everybody. Getting comfortable at the front end of the curve, were you? Yesterday, yields higher by double digits through 520, back 3, down 3 basis points to 517.76. How many years has it been, Bramo, since we've seen yields this high?
It's going back to 2006, I believe.
Wow.
17 years since the last time we saw 2-year yields at this level.
I think we had cycle highs on a 2-year, on a 5-year in yesterday's session.
Exactly.
Off the back of retail sales. Your 10-year right now down a single basis point, 481.75. 30-year, Tom, getting closer to 5%, 493.
5% seems to be the level here, and it's not out of reach. And I would say with the geopolitics of the moment, the president and the prime minister, that you got to frame out a 20-beat move of 10-year yield out to 5%. Not out of the question, based on news flow and based on data dependency.
Let's turn to foreign exchange, and then we can get to the bank earnings. In the FX market, we look like this. For foreign exchange on the euro, 105.61. We're negative on that currency pair by 0.1%. Under surveillance this morning, we have to start with the financials, the bank earnings from Morgan Stanley. Third quarter wealth management net revenue, $6.4 billion. The estimate, 6.58. Shanali Basak alongside us this morning, breaking down some of the numbers. Shanali, what'd you see?
Well, the net revenue number is a little bit short of expectations. And remember, the wealth management business here at Morgan Stanley is certainly the one to watch. You also have fixed sales and trading revenue coming in higher than expected. A long trend with the rest of Wall Street here really capitalizing from the volatility you're seeing in broader fixed income currency commodity markets. Morgan Stanley has been working very hard to grow that business very meaningfully. Now, equity sales and trading comes in at $2.5 billion above expectations. This has been an extraordinary race on Wall Street that does beat expectations, but it does still come in below where Goldman had come in yesterday at $2.9 billion. That puts Goldman in the lead once again. Again, it's a softer market. However, you do see Goldman really fighting to take share among those big institutional clients by leading with their balance sheet, and where Morgan Stanley has seemed to be a little more risk-off.
What we're seeing is also that Morgan Stanley third quarter provisions for credit losses are exactly the opposite of all of the other banks. They came in bigger than expected at $134 million versus $126.2 million expected. Do we have an understanding of what's behind this, of whether they have some maybe corporate loans on their books that are souring pretty quickly?
Oh, that is certainly the case. As we know, Morgan Stanley has some very large leverage loans on their books, including that of X, or formerly known as Twitter. But beyond that, remember, it's still a very small number here that you're looking at for those provisions. That's not really the worrisome part here. That wealth management net revenue miss is a bigger deal, and you're seeing the market immediately start to react to it. Remember, Morgan Stanley, from a price to book perspective, was among the most expensive of banks. Most other banks are trading below their book value, even of the largest banks. JP Morgan is the only one trading at a more expensive level. But remember, JP Morgan's wealth manager really was able to rake in the money here. So what is happening among client sentiment here that is getting spooked by the markets?
I take real issue with the classic Manhattan focus, and Shanali, you're expert at following this, if it's all about deals and it's all about who's number one. I don't think James Gorman gives a damn about being number one or number two. He just delivered, and he put it as line 2 in the presser, a return on common equity, which I'm going to casually say is double Fortress Goldman Sachs. I mean, are we at a shift here where IB is not as important as it used to be? And the fact is it's about persistent cash flows?
I think it's too early to get excited about that point of view here, because investment banking has among the biggest returns on equity typically on Wall Street. We are in a down market. Why is it such a good business for banks? All you're really paying for is the banker, as long as you're not spending too much trying to lend your balance sheet out for these kind of risky leverage loans. But it is a down market. You have these bankers saying it's going to come back. It's a lot of wishful thinking in an era where we're looking at a lot of tensions around the world, and there are a lot of questions about whether they can really be making money on this business over the next year or so. They think it'll come back. But to your point here, the things that are driving their returns, and they're not the only ones, Tom. JP Morgan, Bank of America, Morgan Stanley, now both all inking double-digit returns on equity in this environment.
How much are we seeing a real divergence between the money centers like Bank of America, Citigroup, and JP Morgan from Goldman Sachs and Morgan Stanley that both missed on net interest income, as well as Morgan Stanley saying that total deposits came in below previous expectations in the market? How much does this sort of highlight the gift of free deposits, or basically free deposits for the largest money centers?
That's a great question here, because if are free deposits a gift here? You see Bank of America getting punished all year long for taking those deposits and plowing them into treasuries at too high a valuation. Fast forward to today, and they're sitting on it, and it's the opportunity cost that investors are concerned about. Why get 2% when you could be getting more than that? So it's what you do with those deposits that's the real question at the end of the day. It's balance sheet management. It's getting complicated.
It's a miss for wealth management over at Morgan Stanley. The stock a touch lower, down by 1.6%. Sonali, thank you. 79 in the pre-market. The numbers, Tom, for third quarter wealth management. Net revenue, $6.4 billion. The estimate, 6.58.
And maybe the legacy of James Gorman as they go through a succession process at Morgan Stanley. Sonali Basak, of course, on top of that story. Joining us now with decades of perspective on the shifts in global Wall Street, Gerard Cassidy, to say he's large cap bank analyst at Canada's RBC Capital Markets, barely describes a perspective. Gerard, to rephrase my question to Sonali, where she beat me down and said, Tom, you don't know what you're talking about. Let me go to you, Gerard, to save the day. And that is, I'm sensing a new global Wall Street. They really want persistent cash flows. Is James Gorman showing the future to the other banks?
Tom, I think you're really onto something, and you've got to give James Gorman credit. He's really changed Morgan Stanley from where it was back in 2009, when it was heavily reliant on trading and investment banking, and is diversified into the wealth management or retail brokerage business, if you want, as well as asset management. And it really comes down to consistency of earnings or consistency of cash flow, as you point out. And that's what Goldman tried to do with their expansion into the consumer banking business, which has failed miserably, of course, and they're exiting that now. They want the model like a JP Morgan, which is diversified revenue, or Morgan Stanley, which is less diversified than JP Morgan, but is still more diversified than where it was back in 2009.
Judd, as you know, banks have been a pretty lousy investment in the stock market this year. It's JP Morgan versus everyone else. JP Morgan up year to date by 10%, everybody else down, and some of them down hard. Jeff, what separates what's happened at JP Morgan from the rest? Is it just First Republic?
John, that's part of it, but the performance for JP Morgan, even prior to them acquiring First Republic, was better than the pack. And I think what you have here is a flight to quality. Everybody knows JP Morgan is one of the premier U.S. global bank. It's demonstrated that with very good results, strong leadership, of course, under Jamie Dimon and his senior management team. And every time, John, we go out and talk to institutional investors, the scar tissue from March and May is very thick, and people are underweight the banks. And when we talk to them, they always tell us, we're underweight the banks, but we own one bank, JP Morgan. JP Morgan is owned around the world.
When we look back at this period, Gerard, are we going to say that this was the year that JP Morgan consolidated its heft at the expense of a lot of smaller banks?
I would say, Lisa, that what JP Morgan has done is shown that the diversity of revenue and very sharp, very focused management by the Jamie Dimon and his senior team really has demonstrated really strong numbers. We were talking a moment ago, Tom mentioned return on equity. And if you look at the consumer banking business for Bank of America under Moynihan, Dimon, and JP Morgan, the consumer banking businesses are earning close to 40% return on equity. And as we all know, that's incredibly high for banking businesses. That's what's driving it. And JP Morgan is one of the leaders in consumer banking, and Bank of America.
They are, though, the leading players at a time when they can be selective for the top-rated consumers, right? And this is something that we pointed out, according to Sonali Basak, our own Sonali Basak, yesterday. This morning, what we're not talking about, Citizens Financial missing on net interest income, United Community missing on net interest income, Ally Financial missing on net interest margin, and also having fewer auto loan originations than previously thought. How much is this story dividing even further between the biggest banks and the regionals that are still in a world of hurt?
Lisa, it's a good point, because some of them have been picked out amongst the big regional banks. Citizens is actually the only one that is missed today. When you look at M&T, U.S. Bancorp, and others, they're in line to slightly better. But you're right about certain banks have missed, and it has to do with, and you touched on it in your earlier comments about the non-interest-bearing deposits. The banks with the non-interest-bearing deposits are going to do very well in this higher rate environment because those deposits don't pay any interest, obviously, but they don't move either. People need operational accounts. Personally, we all do, as you know, as well as companies. And that money is gold in an environment like today. And the banks with the higher levels of non-interest-bearing deposits will do pretty well.
Jared, I have to admit, when I read the comments from Brian Moynihan with David Weston in that interview, I was kind of surprised, Jared, because he was talking about the consumer slowdown. Can we just finish there? Retail sales looked great yesterday, really broad-based, big upside surprise. Then the Bank of America boss comes out and says the Fed has basically achieved what it wanted to achieve. We've got a consumer slowdown. Jared, is that a consumer slowdown for Bank of America, or is that a broader story for the economy? Which one is it?
Yeah. John, good point. And the cross currents today, it's always easy to say today is more challenging than 10 years ago or during the financial crisis. It's always challenging, but the cross currents today are pretty strong. And you just summed it up very well. So we're hearing from some folks the consumer is slowing down, but then you see the retail sales number, and it was quite impressive. And if you look at the real GDP now number, which comes out of the Atlanta Fed, which is the current estimate for real GDP this quarter, third quarter, it's over 5%. It's crazy. But I would say that it's not Bank of America specific. And I would say Moynihan, in response to my question on the call, actually, he was pointing out that he thinks it's going to stay around this level. The higher spending a year ago was unusually strong for them, high single digits. Now it's around 4%, should trough out about these levels, but it's still positive growth.
They've been more selective about the clients they serve. Lisa and I have been talking about this for the last 24 hours, actually off the back of the data that Shanali shared with us. These credit scores of these customers, Jared, are so high. Who are they serving in this country? Just a really small slice of the economy?
I think they're serving guys like you, John. They're serving all the, the higher quality credits. So
it's close to 800,
right.
Gerard. Don't disrupt it.
Yeah, but I'm at 242, so be nice.
Talk about it.
I'm very focused on it. How's your credit rating?
242.
242.
Thank you.
It doesn't go there.
But quickly, John, you're bringing up a really good point, and I recommend, I know you guys are busy, but look at their slide they put in their deck, Bank of America, where they compared themselves today to 2009. Totally different company, de-risked, and you put your thumb on it. They're going, higher scored consumer as well as corporates.
Jared Cassidy. Jared, good to catch up. Always is, of RBC. If you're just joining us, welcome to the programme. Your S&P 500 negative by 0.4%. Shanali, that was a standout for a few of us yesterday to see those credit scores of the customer base at Bank of America near 800. For anyone who doesn't track their credit score maybe as closely as some of us do, Shanali, that's very high.
I'm starting to do a lot of analysis on this too, because the average American doesn't have a credit score nearly as high as what Bank of America is posting of its customers. And if you look at the next generation, millennials, and the generation below, it's even worse. Many don't even have a 700 credit score. And so it really begs the question, who is getting a loan and the types of loans, right? I mean, it's worse for if you're trying to get a car or a home equity line of credit.
Just to put this into perspective, I did some review of the FICO realities, and the scores range from, I believe, 300 to 850. The average across the board for for Bank of America's customers is close to 800.
That's nuts.
That's the average, just
and
to
the
give you a
high is 850. So it's, you have to near perfect.
Exactly.
It's insane.
That's where we're at right now.
Let's just say you had a blowout summer. Some of us might have done. You dropped down from 800 just for a couple of months. Just a couple of months of overspending.
This feels deeply
Margin
personal.
call.
I track it very carefully.
Do you really?
I track it very
How
carefully,
often?
yeah. It becomes something that I look at every month, yeah.
Really?
I get an update.
It's like a
I get a monthly update.
A view on your...
It's a view on my spending activities and how...
and whether you could
how
actually
strict I'm
work
being,
at Bank of America.
how disciplined,
and
whether I'm allowed to be a customer of B of A, apparently, based on some of those stats. Shanali, thank you. Great work, as always. Stephen Stanley of Santander coming up in about 45 minutes from now. If you are just joining us, welcome. Your equity market is negative. We're down by about 0.5% on the S&P. Yields are coming in a couple of basis points, 481.54, and crude is rallying just short of 90 on WTI.
If I have to choose a camp, I'd be in the camp of I expect that there will be a bit more tightening by the Fed. So probably an additional rate increase this year. But what's as important, in fact, what's more important is the path of policy over the course of the next 12 to 18 months.
It was Mark Carney there, the Brookfield Asset Management Chair, speaking with David Rubenstein. Mark Carney has been named chairman of Bloomberg's board of directors. If you are just joining us, welcome. Your equity market on the S&P 500 negative here by 0.4%. Yields are lower by a couple of basis points on a 10-year 481.54, and crude with a rally here, Tom, 88.64, up by more than 2%.
I'm getting up to speed on Everton. Mr. Carney cut me off the other day and said my pronunciation was wrong, and I said I'm an ugly American, but he's a big supporter of Everton, so I'm learning.
You said that a few times.
Quickly. Yeah.
Okay.
He's a former governor of the Bank of England. John, how does he react to 6.7% inflation? I was in the news flow, folks. This stuff is all second tier. But I'm sorry, to the people of the United Kingdom, 6.7% inflation is not a second tier.
It depends what's driving it. You can look through it if you truly do believe it's transitory. We found out that maybe this burst of inflation is not. I say that Carney was an interest in one of the news conferences. Sometimes slightly combative in the news conferences on Threadneedle Street. TK, sometimes.
Let's go around the table quickly here on what we've seen in bonds away from the geopolitical news that we continue to give you. Our Oliver Crook is at the Kempinski Hotel with the president and the prime minister in Tel Aviv. John, I still go back to the real yield, 2.40%. Staying there. There's a raging debate, John, if inflation-adjusted yields will have an effect on this economy. My answer is old school, they will.
Elisa was talking about nominal yields, 17-year highs. I've said this a few times already this morning. I think it's worth repeating. You get comfortable with parts of this bond market, and you get punished. We were getting comfortable with the front end.
Exactly.
Steve Major, HSBC, was talking about how maybe the flexibility is all at the long end. We talked about that a million times. Then all of a sudden, the front end, off the back of much firmer data than we expected, starts to speak to the idea that maybe we can bring the Federal Reserve back into the conversation. Perhaps not in November, maybe further down the line in December. What we've heard from lots of Fed officials already in the last 24 hours is a willingness to wait. They believe they've got a little bit of time. You see more of this data going into December. Maybe they come back in. It's Chairman Powell's go tomorrow with David Weston. Let's see what the chair's got to say.
Lisa, quickly, price down, yield up. What are you looking at?
Well, I mean, I think that I'm just looking at how disorderly this ends up getting, the ping pong. It's not just up, it's not just down. It's the volatility and the inability to really frame out what the catalyst is going to be any given day.
Let's go to the disorderly. Winnie Caesar, we've asked to come in, global head of strategy at Credit Suisse, truly expert on the disorder that Bramo sees. How is the disorder in the fixed income world?
This disorder is definitely challenging. It's definitely getting some portfolio managers caught a bit offsides. Like you said, people have been hiding in the front end. That's been a really good trade if you're an investment grade portfolio manager. But now the big question is, when do I insulate? When do I extend duration? And every time that people have tried to do it, it has been the wrong trade. We're still in the camp that you should start barbelling. You should start to extend duration anytime the 10-year is above 4 3/4, 4.5%. But it is going to be a longer-term view, and you're going to have to look through this choppy noise in the near term.
The Fed looked like it was out of the game. Sounded like they were, at least for the time being. Is the data going to bring them back in?
I don't think so. I think that the Fed is going to try to be quite patient, especially with real yields where they are, so long as we continue to see U.S. inflation trend lower, which is our expectation. And while the data have been stronger than we would have anticipated, there's a little bit of something for everyone. You can find some encouraging signs in terms of slowdown, in terms of apparel purchases, technology purchases. Even the jobs report had a little bit of something from everyone in terms of average hourly earnings trending a little bit lower as well.
It seems like there's an irony baked into the market right now where corporations have earned fiscal discipline and are getting rewarded for it at the same time that the U.S. government is moving in the opposite direction, that the credit risk now lies with the government debt more than a lot of the corporations that have immunized a lot of their obligations. How tricky is that making it for a lot of credit investors at a time where they benchmark to full faith in credit in the U.S., which is suddenly full faith in just a little bit less faith maybe in that credit?
It's really tricky. I mean, you could make the bull case for corporate credit that we're going to be trading at negative spreads to sovereigns. I don't think that that's going to happen anytime in the near future. But there is definitely the view that, look, corporate America had a tremendous boon during the pandemic where earnings were much stronger than anticipated and borrowing costs were absolutely rock bottom. And that really helped repair and immunize balance sheets for this move higher in rates. That doesn't last forever. There's always maturities. There's always rolling over of refinancing that needs to happen. It just takes a lot longer for that bite to really hit balance sheets.
All these things are the fundamentals, right? And I just keep going back to this idea that Priya Misra was talking about, the potential for forced sales should people get caught off sides. How much are there enough sort of core bond portfolio managers that are going to see outflows after such losses that are going to be forced to sell regardless of what the fundamentals seem to pick?
So I don't want to jinx the market, but I think if you were going to see those forced sales, it would have happened in 2022. Corporate bond portfolios, while they've been challenged lately, are still doing well better than they did all of last year. There's also a very strong, dedicated institutional buyer base, particularly in the long end of the curve, that is constantly injecting cash into markets. We now have fully funded pension funds. That's going to be a tremendous benefit to the fixed income and corporate bond markets. And we've seen long end new deals in the IG market actually do pretty well as of late. So that gives me some hope that there's still that structural bid for duration and fixed income.
Winnie, you on the high ground in institutional fixed income investment, and it's all this fancy Frank Bobosi stuff you learned at Emory years ago. Nobody cares. Our listeners who are retirees have been destroyed in the bond market. Do they recover by shifting to equities? Do they recover by shifting to what, John? Crypto? I don't know, Manchester United shares? How do you recover from a 3-year train wreck?
Well, I do think that there has been a lot of kind of recovering by buying T-bills, by putting cash in money market funds. When we just look at the absolute balances in money markets, it's amazing, and that's a tremendous benefit.
Can that break the buck? Can it destabilize and break the buck?
I don't think so, but we still have a long way to go in terms of wherever policy ends up being normalized too.
Let's breathe some life into the conversation that Tom's been trying to have, I think, for the best part of 18 months now. At the long end in sovereign debt markets, from treasuries to gilts and elsewhere, we've seen losses of something like 50, 60 percentage points. We're looking at some gilts that were issued in 2020, a 30-year that matures in 2050, trading in the 30s. We're trying to work out whether we fully realize the pain associated with those losses. Have we?
I would like to think that we have. When we look at the street forecasts, 10-year Treasury yields above 5% is not the base case for most people. Now, we've all been surprised by how much higher and higher yields continue to go. And at some point, there is the reality of that interplay between, all right, is this money good? Are we going to get paid back at par in 2050? If so, we should all be buying that, 20-year Treasury that's trading at 47. I haven't been able to find it, unfortunately, but I would be buying it.
How illiquid is that 20?
It's pretty illiquid.
Because you look at the curve and
Yes.
there's just this kink in the curve. The 20 is just doing its own thing.
And there's a 20-year auction today. So are we suddenly going to be talking about
Finally,
20-year
news we can use.
kind of reopening that's going to totally roil everything?
Why would you have a 20-year auction when it's priced the way it's priced? What's the objective there?
They have to, because they already came up with a schedule. And if they abandon it, that will cause more disruption. And these auctions are going to be 25% bigger each month going forward at a time of incredible illiquidity and dislocation.
Joining us
messy
now.
situation.
Yes.
It's messy. Absolutely messy.
Lisa Abramowicz now with ABC Bond House. Lisa, on the 20-year, can it shake up the market seriously this afternoon, like the 30-year, which I didn't care about?
The irony is, yes, it can, even though it's not a very liquid tenor, it's not very popular, it's not a very big sort of total outstanding. I would argue, watch this change everything in markets, not disruption in the Middle East, not any kind of potential good news out of any of the banks. It is going to be ultimately about bond market dysfunction.
Do you see how her voice changes when she starts talking about
She's
this?
passionate about
It's
this.
just like
It's easier to be passionate about this than other things right now.
But if you look at the curve, 3 years and out to 30s, the highest yield on the curve is the 20-year maturity.
It's a kink, yeah.
Just this kink there, and then it drops back down to the 30-year. Something like almost a 20 basis point spread between the two. It's kind of bizarre.
It's the price for illiquidity. It's basically what people are charging to not be able to move it with any kind of regular predictability.
I make it a 23 basis point spread, 22, something like that. It's kind of nuts. Winnie, good to see you. When he sees a credit size following another Big sell-off in the Treasury market. Coming up on this programme, we need to talk about the latest on the ground in Israel. John Lieber of the Eurasia Group weighing in. The President of the United States, Joe Biden, alongside the Israeli Prime Minister Benjamin Netanyahu in downtown Tel Aviv. The latest on the ground with Bloomberg's Ollie Krug coming up very shortly. Going into that, we've got crude rallying up by 2.3% on WTI to 88.65. On Brent crude, that contract up 2%, almost $92 a barrel. From New York, good morning.
The free ride that equity markets enjoyed for much of the last of 10, 15 years, it seems to have come to an end.
I think the Fed really sent the message home that we are going to be higher for longer.
There's no doubt that we're not going back to the free money era.
The market's really now in a daily tug of war with policymakers around the path of rates.
What about the impact from 0 to 5.25 in the last 18 months? We have not seen the full impact of that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Our top story this morning, President Biden in Israel. A diplomatic effort upended by a single blast at a hospital in Gaza. Israel blaming the attack on a failed missile from the militant Islamic Jihad group. Hamas and Arab leaders blaming Israel. America wants an investigation.
I was deeply saddened and outraged by the explosion at the hospital in Gaza yesterday. And based on what I've seen, it appears as though it was done by the other team, not you. But there's a lot of people out there not sure. So we've got to overcome a lot of things.
The stakes for this trip could not be higher. The objectives that much harder to achieve. How to prevent this conflict from engulfing the region and ensure civilians stay out of harm's way. Our team coverage starts right now with Bloomberg's Ollie Krug in Tel Aviv. Good morning, Ollie.
And John, you've just put it in very good terms in terms of the stakes here, but also the difficulty here for Joe Biden, who 24 hours ago told us that he was going to come to the region, come to Israel, come to Jordan, and now that entire trip has been thrown completely up into the air. What we knew originally was this blast at the hospital has completely changed this. What Biden can achieve here is to give his support to Israel, as all of the delegates from the United States have done thus far, continue to deter with the naval fleet that the United States has sent to the East Mediterranean. But the third part, and probably the most critical part of his trip, where he was supposed to go to Jordan to meet with the leaders of Egypt, the West Bank, and of Jordan to discuss de-escalation, to discuss all of the many issues from hostages to aid, that has been completely thrown off the rails by this explosion overnight.
However, an unfair question, but a question of the moment. Sitting to the president's right was the Secretary of State. Is shuttle diplomacy dead on this Wednesday morning?
Well, you have to imagine how Antony Blinken feels now after 6 days of going from country to country and speaking to, people with a lot of different opinions on this matter, and with a lot of different constituents and a lot of different populations who feel a lot of very mixed feelings about what's going on. And it was really him who laid all of the groundwork for this very delicate trip into Jordan, and that, again, has been completely derailed. And this is, again, at the center of this. We have Jake Sullivan here as well. We have the entire cabinet of Israel meeting with the president right now. But again, who we do not have at the table are some of the people that you really need at the table to have meaningful progress in what is a conflict that is only escalating.
Ollie, there were a couple of parts to this trip. One was the diplomatic part, as you were talking about, but there also was a question about humanitarian aid to Palestinians who are still stuck in Gaza. What is the sense that people have of whether some of those provisions will be allowed in and they will get water, food, medical supplies that are running out?
So this is something we've been talking about for the last few days, and there keep to be these sort of stop and starts and a lot of rhetoric saying that Israel will create the conditions under which that border can be opened and some of that aid can come in. As you will know, there are literally hundreds of tons of aid sitting on the Gaza-Egypt border at that Rafah crossing that cannot move right now. And this is going to be, if there's going to be any win here for Biden, is potentially finding a way to get some of that aid in and to sort of throw put an olive branch out for what is, again, a very dire situation on the ground in these hospitals after one that gets hit that is completely inundated with people with limited water, electricity, and internet in Gaza.
Oliver Crook, thank you so much. Greatly appreciate it this morning. John, what are your thoughts here, just moving the last 3-4 hours through this? To me, it's truly history being made.
It was difficult, Tom, and it got that much harder overnight, without a doubt. They want to stand by their ally, Israel. It gets that much more difficult and complex after the events of yesterday, and we still need to work through the facts and try and get some clarity on a situation, Tom, that is difficult to get clarity on. Let's be clear about that. Very difficult.
And my arch theme here, folks, is the change, and the change is the media, the immediacy of the imagery, what we see on social media, what we're seeing with all the modern technology makes for a different conflict, a different war. With wonderful perspective on this is John Lieber, head of research, managing director at Eurasia for the United States. His work with the senator from Kentucky for years on the Hill. John, honored to speak to you. I want to go back to your classroom at Tufts University years ago. You and I lived, you and I studied 1967 and 1973. This is totally different. And yet, are we fighting the last war?
I mean, this conflict has been raging for decades. And, the difference right now, of course, is that Israel is targeting Hamas in Gaza and trying to wipe out their leadership. So it's an enemy that doesn't have tanks and doesn't have planes. It's an enemy that they're trying to, they're going to have to go into civilian areas to target. And, the Israeli Defense Forces over the years have become, have been attacking these lands. And it's really difficult to get after Hamas that way. I think one of the big questions is whether or not there's going to be a ground invasion anytime soon. And I suspect that one of the things Biden is in the Middle East trying to hold off on is that ground invasion because of the risks of these horrible atrocities that happen against civilians in times of war. And that's got to be one of Biden's main objectives, in addition to trying to stabilize the region generally and make sure that, most importantly, Iran stays out of this.
John, we know what Israel's objective is, the ultimate objective. You alluded to it, wipe out Hamas. Let's talk about how difficult that is to achieve. Where is the leadership of Hamas? Where does the financing for Hamas come from? How do you wipe out Hamas purely just by going into Gaza and having a full ground invasion?
Well, obviously you can't. And I think what time has shown is that when going after these terrorist organizations, even when you go after when you successfully take out the head of these organizations, there's other leaders who will rise up. The U.S. has been targeting Hamas financing networks for decades through money laundering efforts. They're going after their ability to conduct financial transactions in crypto. But it's unlikely to me that even if the Israelis are completely successful in this campaign, that the threat on their borders is going to go away because of the fact that there's so much history and anger here. And, getting rid of Hamas probably means somebody else comes up.
Especially given all of the protests and anger. There's been some fiery rhetoric out of Iran over the past couple of days threatening some full-scale invasion of Israel if there is any kind of ground escalation into Gaza. How can you read between the lines to understand just how much resolve there is by Iran to get more intimately involved, to order Hezbollah troops to come in from the north?
Yeah, that's one of the big questions in this war right now is, does Hezbollah get involved? Does the war expand to Israel's northern border? And I think it's notable and interesting that the U.S. and Israel have really gone out of their way to say, we don't think Iran was directly involved in the attacks against Israel that occurred last weekend. Of course, Iran is complicit in financing Hamas, financing Hezbollah, and giving them support over the years. So right now, it looks like the U.S. goal and the Israeli goal is to keep the Iranians out of it. That doesn't mean you won't see over a longer period of time kind of a shadow war that the Israelis have been conducting against Iran continue. That may not mean direct armed conflict, but it could mean cyber attacks, potentially targeted assassinations and things like that. So far, Iran's giving no indication that it wants to be involved, but is sending really strong warnings that if the Israelis escalate, they could get involved. And that is really what makes the situation such a powder keg.
John and Tom earlier this morning were really rightly pointing out how little we actually know, how difficult it is to ascertain with any clarity the facts on the ground in a fast-moving war with a lot of sort of people of varying dependency giving information. John, how much has the landscape shifted over the past 12 to 18 hours, given all the protests, given the outrage, given the statements from Egyptian and Qatar and Saudi Arabian leaders?
bombing at the hospital was obviously a major event in the course of this short war so far. But there's a lot of ambiguity about who did it, how many people were killed, and it's really, really difficult to ascertain the facts because there's not a lot of independent media on the ground. It's not like a lot of forensic investigators can get into Gaza to figure out what actually happened. Some of the photographic evidence that came out this morning suggests the blast wasn't as large as initially said. But I think the key point here is that with Israel launching attacks on civilian populated areas, if it wasn't this hospital attack, it would have been something else. And it was only a matter of time before anger at the Israeli Defense Forces spilled over into the Arab streets and led to some blowback on Israel just because of the nature of these operations. And so you've got a very uncertain information environment and a very deadly military environment, and so the battle of the narrative is going to be really, really difficult for any one side to win in this situation.
John, let's talk about the military aspect of this as well, and let's finish there. Just going through this major monster deterrence that the US has been building up in the Eastern Mediterranean, in addition to 2 aircraft carriers and the ships escorting them. I had a report from the Washington Post yesterday that the US is also sending an amphibious task force aboard warships. John, how meaningful is that as a deterrence in the Eastern Med?
I mean, militarily, nobody can defeat the United States, right? I mean, it's the most powerful army that's ever existed. It's got vast, seemingly limitless resources. There's some question as to what ability they'd have to fight and to support the Ukrainian effort and support the Israelis. But I think that the real question, if I'm one of the regional players who are looking at getting involved in this conflict, is does the U.S. have the political will to get involved in such a conflict? And I mean, it's difficult. It's difficult to see the U.S. Committing troops on the ground here, but they obviously so far have been supporting the Israelis. And I think what this really is a show of force that's meant to deter any action. So there's no question that if there were to be any additional strikes beyond Gaza, that the U.S. could get involved and win this decisively.
Hey, John, good to get your perspective. We'll catch up soon, hopefully. John Lieber there of Eurasia Group on the current situation on the ground in Israel and across the Middle East at the moment. If you are just joining us, welcome to the programme. Here's a snapshot of the price action currently. In commodities, a bit of a rally. The rally fades a touch. We're up by 1.8%, $88 on WTI crude in the equity market. Equities on the S&P 500 negative here. On the S&P, we are down by 0.36%. Yields are going absolutely nowhere, 483.43. The bond market been going somewhere, though. That's been lower, and yields up over the last couple of days, big time, both at the long end and the front end as well. I think we've got to fold in what the president might be asking Congress for. Lisa, the White House eyeing $100 billion for Ukraine, Israel, and the border. That, according to people familiar with the matter yesterday.
I saw those figures, and I was wondering, is there going to be the political will to finance this? And it really highlights the difficulty of having a massive budget deficit at a time where there are a lot of concerns in the world, where we're actually, on the wane when it comes to an economic cycle. How does that challenge the U.S.'s ability to spend that kind of money, which they're going to do, right? I mean, let's be honest, but then how much are yields going to go up on the other end?
You mentioned Terry Haynes earlier, John. I'm going to channel Mr. Haynes as best I can, and that is there's something in here for everybody. They've got to create a political constituency, and you can do that with 2 wars and a border. And that's how you get the necessary votes in a completely fractured House and maybe in a partially fractured Washington.
You think this House, potentially led by Congressman Jordan, is going to go for some of that spending?
They're going to have enough. I think what Mr. Haynes and others of his ilk would say, Vallier and the rest of them, is they're going to put enough in here where you can't say no. It's a double negative. I mean, I can't say no.
Are they going to be able to have a vote on it? I mean, that's where we're basically at, because Jim Jordan was knocked down as the potential House Speaker. He's got another vote coming up today. So can they even hold the vote, let alone pass it?
Terry Haynes of Pangaea 2 Mondays ago, kept it very simple. He said if he thinks the odds have gone up that we select a speaker and the odds have gone down that we'll get a government shutdown, you're wrong.
November 17th.
That's what he said. You're wrong. The deadline, of course, November 17th. On the economy, Stephen Stanley of Santander. That conversation about 20 minutes away. In the equity market, negative here, 0.4% from New York. This is Bloomberg.
Thursday, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens October 19th at 12 p.m. Eastern on Bloomberg. Context changes everything.
This cabinet came together and standing strong, standing united, and I want you to know you're not alone. You are not alone. As I emphasized earlier, we will continue to have Israel's back as you work to defend your people.
President Joe Biden speaking in Tel Aviv alongside Israeli Prime Minister Benjamin Netanyahu, standing shoulder to shoulder with the people of Israel. If you're just joining us, here's the price action going into the opening bell. 1 hour and about 15 minutes away. Equity futures on the S&P negative 1/3% on the S&P 500. In the commodity market, crude rallying, but those gains fade, up by 1.8%, $88.22 on WTI. Looking at bonds, major move yesterday once again, this time at the front end, yields up. This morning yields going nowhere on a 10-year. We'll see if that changes later in the session. Your 10-year 483.43. Remember this conversation, Tom. When bad things happen in emerging markets, you sell the sovereign debt of those respective nations. When bad things happen in DM, you buy those bonds in those respective nations.
That's the theory.
Is that changing in developed markets?
That is a debate right now. That was a heated debate in Morocco at the International Monetary Fund meetings. Joyce Chang, I thought of JP Morgan, was really, really quite good. We had the same conversation, I believe it was April, at other institutional meetings of the concern of EM. With a brief this morning with all the news flow, including in the Eastern Mediterranean. Diana Omo joins us with Kirkoswald Asset Management and on desks of EM market makers for years. It's so good to talk to you, particularly off the Barry Eichengreen paper at Jackson Hole and what Joyce Chang talked about at IMF. How bad is it? Mexico is stellar performer even there. Peso off the high is a weaker 8%.
Well, I think what's happening right now is actually the dollar has reemerged again. There's been a huge amount of upside surprises from a U.S. economy perspective, and that's giving a bid to the dollar. Additionally, you have geopolitics, and people are buying dollars as a safe haven. So the combination of those two is taking off some of the shine in emerging market currencies that we'd seen up until the summer.
Stan Fisher wrote that little red book everybody was forced to read. I think it was 1999, 1 year after 1998. Mm-hmm. Are we anywhere near the instabilities of a given crisis in Ecuador, a crisis in Mexico for that matter, or a crisis in Southeast Asia? What's the level of instability you perceive in EM?
Much less than during COVID, because I think a lot of the vulnerabilities were addressed during that period. The insolvent economies are already talking to the IMF, and I'm sure you heard a lot of that in Morocco. The IMF
Tom, don't ask about Argentina. Okay, continue.
The IMF is standing ready to support economies. So we don't necessarily think in the next 1 to 2 years we are likely to see anything. There's maybe 1 or 2 credits that look vulnerable, that have maturities coming. But broadly speaking, I think EM should be able to muddle through.
In 30 years' time, will we have a restructuring plan for the United States of America? Is that where things are going? Where's this headed? Where is this going? When you speak to emerging market nations, how are they thinking about what's taking place in America? For all the preaching they've heard about how they should manage their finances, what are they saying about this in Washington?
Well, they've clearly lost the handle on fiscal in the US. It feels like whatever is happening, whether it's political impasse, the answer is let's spend some more. When it's geopolitics, the answer is let's spend some more. And you've lost your price-insensitive buyer. We had the QE that was supporting this. Now the markets have to figure out how much premium you need to be if you expect more issuance to come forward.
Yeah, moments ago, Lisa, Damian Sasso are out watching this, and he makes clear he agrees with Diana. He sees quality reserves at EM.
Right. What does quality mean at a time where you've got a treasury yield that is going up and away? Diana, I do want to just sort of put a bow on that point. Are you saying that we have seen the reaction function to weakness? We have seen the reaction function amid a search for safe havens, and treasuries no longer get that bid in a reliable way?
Well, they got the bid when we had the geopolitics headlines a couple of weeks ago. You saw the move in treasuries, which rallied as people still saw them as a safe haven. But despite that ongoing, as soon as we had a bit of stability, markets were quick to unload these treasuries. Because what are we hearing? There's another 100 billion potentially that's going to be spent to support these economies, and markets simply don't have the appetite.
Do you think that this pain will be reserved to the U.S. government debt market? Or is it the kind of theory where when the U.S. catches a cold, the rest of the developing world catches a flu?
Well, I think there's two big elephants in the room, the U.S. and the BOJ, where sovereign debt issues or sustainability have been a concern, but more of a slow-burning concern for a while. Now, while these are playing out, I think they will tend to take everything with them. But it's the speed of the move that matters. And we've had a pretty aggressive move in treasuries. So if, going forward, we say maybe treasuries can go from 4.5 to 5.5, but we're not necessarily going to see that happening in a 6-week period, I think markets can handle that.
Where can we hide? Where can we hide in the
You know
air?
what I'm going to say?
Go on.
Emerging markets. You're actually getting paid to do the work now in EM. EM high yield yielding north of 10%, EM IG yielding north of 6%. Looks like an interesting space. That said, it's not a one-size-fits-all. Tom mentioned Argentina. We still have cases like that look very vulnerable. I think this is a period where if you do your bottom-up security analysis and you know the stories that you're buying really well, there's a lot of opportunities in emerging markets.
What about Turkey? Fascinating leadership shift taking place in that country. What is going on?
I mean, it's like a total... We had the same outcome in the elections, but it's like a totally different leadership.
It's amazing.
Yeah, so they've embraced orthodox policies now. They're speaking the market talk, and markets are responding well to that. We've seen aggressive rate hikes and a commitment to actually fight inflation, which is refreshing to see.
When you talk about developing markets, I have to think about what's going on right now, in the Middle East, and just wonder how closely you're following this as a potential, not only humanitarian and a question around what's going to happen and how wide the conflagration goes, but what this means for the ability to invest in some of these nations.
Well, it's clearly a sad turn of events, and we're obviously following it very closely. I think what the big concern is, beyond the humanitarian cost of lives, is what does this actually mean for, one, the region, stability within the broader region? Are we going to see spillover effects in the Middle East? Are other countries going to get pulled into this? And you've seen actually markets repricing. You've seen CDS in some of these Middle Eastern economies actually move quite high because markets are assigning a premium that it's a non-insignificant risk that you could see spillover risks coming in. And I think broadly speaking, beyond the Middle East, it's oil prices obviously is the next big one because you have this potential supply side shock. And that could actually make monetary policy much trickier going forward if you see inflation starting to pick up again.
Diana, this was great. It always is. It's got to catch up. Don't be a stranger. Diana Ramo there of Kirkus Asset Management. Speaking of crude, Brent crude off session highs, still in the 90s on Brent right now, 91.36, up by 1.6%. WTI 88.10, up by about 1.6% this morning off the back of that continuing tension, Tom, in the Middle East.
Yeah, I'm looking at 30-year bond, and I'm going to put up a quick 20-day chart here, John, and it's just real simple. 30-year bond buttressed up and about ready to go through October 4 to new highs near 5%.
The 2-year yield yesterday through 520. Up by 11 basis points on the session. Phenomenal move this morning. The 2-year just about unchanged, down about a basis point of 519.47. Lots to discuss in the next hour on Bloomberg TV. The lineup looks like this for the open. Mike Schumacher of Wells Fargo was bullish. Still somewhat bullish, just badly bruised by the bond market over the last couple of months. We'll catch up with Mike in a moment, alongside Gershon Distenfeld of Alliance Bernstein, Nadia Lovell of UBS Bramo on the equity market. Attention shifts from Wall Street. Bank earnings basically done now for the major players on Wall Street with Morgan Stanley about an hour ago. Then it's on to tech. After the close, we get Netflix, we'll talk Tesla, and we'll push on to the big players in the next couple of weeks.
And how much does that set the tone if you continue to see the strength that so many people are expecting? How much is that going to be a negative? And I keep going back to the irony. Geopolitical risk, not a concern for equities. The concern about a slowdown, actually good for equities. upside beats, it's over.
Bond yields apparently didn't matter to equities yesterday, really, either. The S&P was just about unchanged off the back of a big move higher at the front end of the curve. Lots of Fed speak still to come. Chairman
Thank
Powell
God for that.
talking tomorrow. Your equity market negative a third of 1% from New York. This is Bloomberg.
Bloomberg Surveillance, and we welcome all of you worldwide. Lisa Abramowicz and Tom Keene, John Ferro preparing for another hour. John Ferro and we are waiting for comments from the president. We have reports that he may make comments in Tel Aviv as he meets with Mr. Netanyahu. Our Oliver Crook is in Tel Aviv at the Kopensky Hotel on the beach of the Mediterranean, and we will see if we'll get reports through the morning. Right now, as we look at what we do, economics, finance, and investment, we can understand that Michael McKee will go into a great length here on housing, because I've got to go refinance my home at 10% right now. Mike, what do you got?
Good luck to you, Tom. You might want to get a new home, though. Looks like there's some more of them for sale. We did see an increase in new home starts compared with what we had seen the month before. 7% up, which is a little lower than had been anticipated, 7.8%, but better than the negative 11.3% in the month of August. Puts us at a 1,358,000 annual rate. Building permits up by, or down rather, by 4.4% after a 6.9% rise the month before. We're at a 1,473,000 rate there. Now we just see the housing starts number has been revised to negative 12.5 for August, so it is a maybe more significant gain than it would initially appear. Single-family home starts up 2% during the month. That's about 10.8% above the revised August figure, and multiple unit dwellings are up to 383,000. So looks like some strength in both areas at this point. But Tom, well, let's put it this way. You're not going to get a good mortgage rate, but you will get attention from your mortgage banker, because
they're not doing anything
earlier
else.
today,
Yes.
Mortgage applications fell to a 28-year low.
We've been
May
looking-
1995.
We've been looking at our credit ratings, and I'm clocking in at a 285, so it's not going to happen.
That may be good enough for a mortgage banker who has.
I don't think that they go that low. But I do think, I'm talking about FICO scores, I'm curious right now, not seeing much of a reaction in markets, just to pick up on this idea that you're not seeing mortgage applications anywhere near anything we've seen over the past 3 decades. There is a question of whether this is a broken market, and this is indicative of trying to fill some of the demand with supply that is not getting unleashed, because nobody is taking out a mortgage, nobody's trying to move, and nobody feels that kind of mobility. How much does it make it difficult to read anything into this data?
Well, it's hard to read a lot into the data, except that it does appear that builders still have some confidence that they can sell homes, because they're the only market in town. There's just no inventory in existing homes right now, because who wants to sell their 3% mortgage for a 10% mortgage? So at this point, yeah, the market is broken, but to the extent that household formation demands new housing, you're going to see some strength there. If that turns down, then you have a real problem.
Mike, stay there. I don't want to go away. We got Weston with Powell tomorrow. I want to get a brief from Michael McKee on that in the coming minutes here. We are thrilled to bring you someone of immense acuity on the algebraic equation of real GDP. He digs deeper than most. Stephen Stanley is with Santander Capital Markets. We were talking beforehand, and I want to go to the 8% solution, which is the 30-year mortgage, which I quote all the time, is 7.9x, whatever it is. And you said, Tom, it's about refinance, and we're enjoying an 8% refinance rate. Can America refinance now and do things?
Well, certainly if you own a home, you're not likely to be refinancing anytime soon, because rates are higher than they've been in a very long time. So the good news is, as Mike and Lisa were saying, is that a lot of people are locked in at 3 or 4% on their mortgages, and they're not really feeling the pain. The people who are feeling the pain are the people that are in the markets.
Critically, I've been dying to ask you this. Do you perceive this as a policy, as a needed policy solution, or do we just let the market play out over the next number of X quarters?
Well, I would say if you pan out and look at the housing market very broadly, The main issue for many years, and continues to be the main issue, is an imbalance between supply and demand. There's not enough supply in the market. So clearly, higher mortgage rates will hit demand, and I think at least temporarily help to bring that market into better balance. But when we think about where we're going to be in 2 or 3 or 5 years, I think the big issue, public policy issue with regard to housing, is still going to be one of ensuring adequate supply.
And there's been an ongoing concern about just how direct the transmission mechanism of monetary policy has been, given how people are locked into 3% and 4% rates. The one entity that has felt the increase in rates probably the most directly is the U.S. government. How much further do you see longer-term yields rising, especially in light of some of the defense spending that we've heard being proposed by President Biden?
Yeah, it's interesting because, I think one of the most overrated influences on interest rates and the Treasury market has always been the budget, right? People always talk about, the rates are going to go up because of the deficits, and it rarely happens. But I think we're in a rare instance where it has really, over the last 3 or 4 months, it has started to enter the psyche of investors. And unfortunately, I don't see any near-term solution here. Getting just a very small increment of fiscal austerity in the spring tied to the debt ceiling agreement was like pulling teeth, and we're still trying to implement that, and that hasn't been easy either. But I don't think we're going to see anything else on the fiscal front until after the election.
The lack of fiscal austerity, how does that translate into a yield call for you, or a changed view on how far yields can rise?
Yeah, I think you have investors who always viewed the Treasury market as the gold standard, right? This is the ultimate quality market in fixed income. And I'd still say that's the case, certainly on a relative basis, but I think people are, maybe a little less enthusiastic. So yeah, it does, I think, translate into higher, longer-term yields.
One more question. I want to bring Mike McKee in with you and go all macro on us as well. What is your new confidence in calling a Q4 GDP statistic? We've been jobs, shocked. Retail, shocked. Phillies, shocked. I mean, it's all there. What is your call on Q4 GDP, or do you have no belief?
Well, I mean, we've seen a lot of zigzagging, right? So we'll get a strong quarter and a weak quarter and a strong quarter and a weak quarter. Clearly, Q3 was a strong quarter. And after yesterday's numbers, it looks like it could be as high as 5%.
Wow. You're saying the quarter we're in, the past quarter, Q3, is a 5er?
It could be, yeah. It's going to be close.
Do you agree, Mr. McKee?
I don't add up the numbers like Steve does, but the folks down in Atlanta say
5.4. Yeah.
And so that is amazing, which then sets you up for at a higher starting place for the fourth quarter. And it looks like spending has been strong in recent months. So.
Right. As Lisa would point out, both you and your ilk have been wrong for like 3 years. So we'll go.
I was at an event last night, and I said, well, I'm an economist at Bloomberg. And they said, well, at least you're not a weatherman.
Well, we're closer in New England. Speaking of events, Mr. Weston will speak to Mr. Powell tomorrow at the Economic Club of New York. What's the question you would ask?
Well, the question that has to be asked is, what do you do next? And then when you raise rates higher for longer, how long is longer? The interesting thing is that their September meeting, 12 members of the Open Market Committee said they thought we would have another rate increase this year. Since that meeting, 12 of them, not the same 12, but 12 of them have said, well, maybe we don't need it. But then, as Tom pointed out, we have all these very strong economic data points. So how do they square that with what they're going to do November 1st, or do they push it into December, but still raise rates? And then for how long?
Right now, we're going to go back to Tel Aviv. It is a movable feast of information there. Our Oliver Crook is at the David Kopinski Hotel. This is on the shores of Tel Aviv, looking over a Mediterranean with 2 sets of U.S. Navy fleet out in the distance. Oliver Crook, what does the president's afternoon look like in Tel Aviv?
So he arrived here this morning, and he met with Netanyahu right there on the tarmac, who really greeted him very warmly and is very happy to see the president, saying that the only thing better than having a friend like you is having a friend like you here in Israel. And then he came straight to the hotel here, where he held bilateral meetings. After that, currently, from what we understand from the president's movements, is that he's in the current cabinet meeting with the wider delegation of Israeli officials. And then after that, he will meet with some of the victims and the family of the victims of the attack from last Saturday in the south of Israel. And we expect to hear from the president, as we've heard from him sporadically throughout the morning.
Oliver, what's the scene in terms of potential protests and how the Israeli authorities are really thinking about how to proceed to not ignite more furor, more of some of the unrest that we've seen overnight?
I think that this is the very, very difficult question, and I think that this was one of the questions that Biden wanted to come and help within the region to try to diffuse a little bit. Remember, this is a trip that originally had two legs, the first in Israel and the second in Jordan, and that second part of the trip has been canceled after that explosion at the hospital in northern Gaza, and that makes the task all the harder for the president. And again, what can he walk away with? Yes, he will show his support for Israel. Yes, he will show deterrence, but this third part, the diplomatic part, is what is going to be radically missing from the president's visit to the region.
Oliver, the horror of the last 24 hours, there has to be a process to determine how this hospital was destroyed. From where you sit, with the Israeli media, with all of the press there, what is that process going to look like?
Well, so I can tell you this is going to be a very complex process, and it's important to not jump to conclusions. Very early on, Egypt and many of the Arab nations blamed Israel for this bombing, saying that it was from their bombardments. Netanyahu quickly said that it was not their target, and overnight we've had the Israeli Defense Forces coming out and putting out what they say is evidence, video evidence, but also phone recording evidence that this was not their doing, that this was in fact a product of Islamic Jihad, another militant group within Gaza. They say that 1 in 5, they've said this in the past, of missiles and rockets fired from Gaza actually misfire and fall back on the territory. So I think they'll be coming through all of this evidence, and there was enough evidence apparently for Joe Biden to say that he believed the Israelis, that this was in fact not their doing.
Oliver Crook, thank you for reporting from Tel Aviv. The president meeting with Prime Minister Netanyahu. Lisa, the story continues here, and it's fluid, to say the least, into the Israeli evening.
We keep trying to struggle with how to fold what we do every day, which is markets, into a story that has deep implications socially as well as from an economic perspective. It is unclear, and the lack of information in the fog of war makes it that much more uncertain and difficult to report on, and I think that we're all coming from a place of great humility.
The fog, I should say, of data check is I'm not going to call it a spike, too inflammatory, but a lift in the 10-year yield, and we are right now buttressed up against new highs. We'll have to see how that unfolds coming up. In the equity markets, S&P futures at -19, the percentage a -0.4%.
Still with us is Stephen Stanley of Santander, and I want to get your sense. We did hear a couple of references by Fed officials yesterday to what we're seeing develop in the Middle East. How does the Fed respond to something that could potentially send oil prices higher and further the inflationary pressure?
Right. I think it's very difficult, right? The initial reaction, I think, is one to say, okay, well, we have uncertainty and maybe we're supposed to be patient, let that play out. But as you say, the implications are not clear. In the past, the Fed always looked at an increase in oil prices as a drag on the economy because inflation was always and everywhere low, and now all of a sudden that's not the case. So,
in the blur here, we've got time for one more question. As Lisa mentioned earlier, the silly banks are over. I don't know if Santander reported. I hope they did well. But the answer is now the real earnings season starts, and it's about the top line, which is about nominal GDP. You're giving me a 5 number for Q3.
For real.
We've got some for real.
Yeah.
Add on inflation. Are we completely misjudging the corporate enthusiasm for revenues?
Well, I think, in general, we'll see how the third quarter plays out. But in general, corporations have pretty easily exceeded expectations consistently, at least so far this year. So I think the consumer remains resilient. We've seen that. There's certainly reasons to be worried going forward, but at least for now, as long as the labor market is strong, I think that bodes well for the consumer and in turn for corporate America.
Stephen Stanley, thank you so much. It's not enough there. The Stanley treatment's not enough to get me out of triple leveraged all cash. It's not going to happen.
Maybe next year when we're in
I'm looking at an odd lot on Apple shares. We'll see November 2nd. Stephen Stanley, of course, Santander, U.S. Capital Markets. Please stay with us. Coming up, this is vital, head of all of our hydrocarbon coverage worldwide. Will Kennedy, your brief on Brent crude, $91.43 a barrel. Yields lift in the last 20 minutes.
oil is the key worry point here amongst the sort of assets we look at. It's a big deal. I'm worried about it, but I do think it ultimately self-corrects, right? Every dollar you go over $90, I think, is everyone's trying to use less oil. And I think our economies are just different now than they were, 20, 30 years ago.
Everyone's trying to grapple with how to understand the geopolitical risk in terms of markets that are cold-hearted. And for now, largely looking past it. Ben Liedler, global market strategist at eToro, on earlier with us. Right now in the market, you aren't seeing that much action, save for the bond space, where you see yields just still hovering near the highest levels they've been going back to 2007, 2006. And Tom, I mean, even though the S&P, yes, it's lower by 0.5%, and you could see a bit of dollar strength here, it really is the 10-year yield at 4.87%, if you round up, near the highest going back to 2007.
Well, it's called a benchmark, and folks, I rarely do this. I know Will Kennedy's waiting to give us wisdom here, but it makes this 20-year auction not a Tom Keene small, laughable item today.
Yeah.
I'm wrong. You're right.
Especially given the 30-year auction just days ago. We are going to get to crude in just a minute. I do want to just go over some of the bank earnings that we have been getting. We did talk about Morgan Stanley and how their wealth management net revenue came in light, $6.4 billion versus the estimate of 6.58%. Those shares lower by 3.5%. I do also just want to point to some of the regionals. They are struggling. They are not reporting the same kind of stalwart, solid results that we saw from Fortress Diamond. Citizens Financial came in with net interest income that was below estimates, net interest margin below estimates. Ally Financial reporting a greater degree of souring loans. And you can see both of those shares being punished. Citizens down 3.5%, Ally Financial, Tom, down 2.8%. And regionals may be the real story.
Keith Briette in Woods, Thomas showed with us yesterday, the BKX index has a PE under 8. That's like my ute, Lisa.
And we've been talking about, does Bank of America really represent mainstream America? Questionable with a FICO score of 798, but some of these regionals do. We do have to focus on oil, given that we have seen that as the place that people are expressing some of their concern about the unrest percolating around some of the attacks, the explosions, the situation in the Middle East. Joining us now is Bloomberg's Will Kennedy in London. And Will, I just want to get your sense of what people in the oil market are looking at to understand how to play a fraught and very unclear story.
Fraught and unclear, I think, is exactly right. And I think that the oil market feels that to some extent. I think the word I would use is twitchy. As things stand, there is no particular reason that oil flow should be disrupted or that oil should go a lot higher from here. Although there are scenarios where things become a lot more drastic, and that's what is making people slightly twitchy, as I say. The most extreme scenario is, of course, Iran's involvement in a broader conflict, and that's why some of the headlines today where Iran said that they would embargo Israeli oil imports got the market going. Now, it's a rhetorical device. Iran imports very little oil, 200,000 barrels a day. It gets it from non-Middle Eastern countries, places like Azerbaijan and Kazakhstan, and other people wouldn't join in the embargo anyway. So it's not a fundamentally important piece of news, but this increase in rhetoric gets the market excited.
Will, the map out on 1967 and 1973 is something like 140 miles from the southern edge of Gaza into Egypt, spilled into Egypt, down to the Suez Canal. In any of this, is the Suez Canal at risk?
I don't think that's a fundamental concern for oil traders, but I think that shipping is a concern in more extreme
Expand
scenarios.
on that.
So the place that people worry about are the Straits of Hormuz, the gap of the place at which the Persian Gulf joins the Indian Ocean, through which all the oil exports from southern Iraq, from Iran, from Kuwait, from Saudi Arabia, from the UAE, they all go through this pinch point over which Iran has a big amount of control. So the most extreme scenario that people worry about, the scenario that would send oil way past $150, is if shipping became impeded through the Straits of Hormuz. Now, it's not likely. I don't think people need to worry about that right now, but that is the extreme case, the worst case scenario that people think about as this situation develops.
Interesting to see. Will Kennedy, if I look then at oil here, It's Javier Blas and your entire team, particularly the team in the trenches here of hydrocarbons, are you framing out a path to 100? Are you even able to do that with this geopolitical uncertainty?
I think it's quite binary. I think the main scenario is that we stay in the sort of 80 to 95 range. There's a sort of $5 risk premium in the market now. That's what a senior oil trader described to me in a conversation yesterday, that this whole crisis has probably added $5. But in most scenarios, there's not significant disruption to oil flows, and things carry on pretty much as they are, and there's concern about the macro and the buyback. But there is a binary scenario. There's an extreme but unlikely scenario where prices go much higher. And one interesting thing we've seen is some activity in the options market where people are buying calls well above $100, which shows that there are people who are buying protection against those unlikely but severe scenarios.
Will Kennedy, stay with us. Lisa, the emotion of the President of the United States speaking to people, first responders and people who are directly associated with the horror in the Eastern Mediterranean, in Israel and in Gaza.
This comes after a reported meeting between President Biden and the War Cabinet, including Benjamin Netanyahu. A big question around what the focus was, given that diplomacy has really been at least put on pause, if not shattered, due to some of the reactions overnight. Now, President Biden going around and meeting with some of those in Israel in the show of support that he is demonstrating.
It's a diplomatic issue here, but what I find so fundamental is the immediacy of this new war, or the immediacy, to take it away from more of conflict, in that the film is in real time and it adjusts the diplomacy and the optionality in real time.
There's a question also about any kind of escalation, which is what people in the market have been watching. I am curious, Will Kennedy with us still here, and I am curious from your vantage point how you interpreted some of the Iranian rhetoric saying that they were going to call for an Israeli embargo on oil, talking about the potential for escalation. How are people in your industry reading through this to understand what's real, what's potentially disruptive, and what's not?
I think the comments from Iran today were rhetoric. I don't think they will have much real-world impact. As I said, Israel imports just over 200,000 barrels a day. That's minuscule in the context of the global market. It gets that oil mostly from countries in the former Soviet Union. But the rhetoric matters here. The background matters here. And as the situation deteriorates, as Iran's words become more severe, I think that worries traders, that they have to think about worst case scenarios, as I said earlier. And that's the background. They're looking for any signs what worries them about Iran stepping it up.
Will Kennedy, thank you for the oil brief from you and your team, particularly in Europe and in Dubai. The President of the United States, the filming that we have right now, a bit cacophonous here, in a room meeting with people, first responders, we're told, and victims. A typical Joe Biden moment, you would say, but certainly heartfelt. Lisa, what I would say here is the world awaits comments from the President. I don't know if we'll see that today. We heard comments earlier with the Prime Minister.
Given that the diplomatic efforts seem to be have been, at least in the short term, torpedoed, there's a lot of focus on how to get humanitarian aid to those in Gaza. The discussion that President Biden was saying, it is the how that they really do say matters in terms of how Israel goes about this. What are they doing? Who is the main obstacle to getting aid to the Gazans that are on the border, trying to just find food and water and medical supplies?
That is the aid as well. I would wonder about the military brief away from this, and that there's still the presumption of some form, and I have to be careful here, ground, air, sea offensive by Israel upon the Gaza Strip, now somewhat governed by Hamas. I mean, it's been that way for a number of years. The military seems to have taken a back seat today to the diplomatic discussions.
There's very little that I can really draw a conclusion from, save for just how emotional this is, especially given that some of the victims and the families of the victims include people whose kids and their family members were kidnapped and being held hostage, just showing how difficult this moment really is.
We're going to leave you with the data which is moving here as we see images on radio, images with blue and white flowers, the President of the United States meeting with the people of Israel. Yields move. The 30-year bond, 4.97%. The 10-year yield up 3 basis points, 4.86%. Standard & Poor's futures, negative 22. Good morning.